I was always the health.
Will.com.
Won't do here.
Good morning. Welcome back to Squawk Box right here on CNBC on a Friday morning. We're live at the NASDAQ market site in Times Square. The futures right now looking up after what's been call it a complicated week. Maybe that's a polite version of it. The Dow right now up about 41 points. NASDAQ up about 884 points. The S&P 500 up about 36 points, Joe.
The tension between business groups and regulatory agencies is increasingly playing out in court. Megan Casella has more on why the volume of cases has soared. Good morning.
Hey, good morning, Joe. So the Chamber of Commerce's lawsuit against the FTC this week marked the 7th time the group sued the Biden administration this year so far. And it comes as banking and business groups have really been pushing back against what they see as regulatory overreach. So if you compare this to previous administrations, the Chamber filed 15 lawsuits against the Obama administration in its first term and just 3 against Trump, but they expect to file at least 22 lawsuits against Biden by the end of this year. Now, it's not just the Chamber. The American Bankers Association has also filed 4 lawsuits against the administration, against banking regulators in the last 18 months
Everything
or so,
changes
after
the
not
moment
signing
you
on
step
to
on
any
board.
lawsuits against
You
those
can stand.
regulators for roughly a decade before that. Now, these suits come as total regulation has increased under Biden, according to one metric from George Mason University, and you can see that here. And while the Chamber views litigation as a last resort, it says that it's choosing to sue when it sees agencies acting outside the limits of their authority.
It's not just about a single regulation, right? It's about the 1,000 regulations that are going to go final this year. And so we went from a time where we would argue about a particular regulation to a period where the concern is about the direction as a whole.
Now, the Biden administration says that its goal with all of these regulations is to protect consumers, but these groups say that it creates an environment of regulatory whiplash. Joe?
Yes, indeed. Very good, Megan Casella. Thank you, and I think I'm headed your way. I think, Andrew, maybe headed your way. You'll feel our presence. I get a rash when I get too close to, right when I, huh?
So do they.
With me on my way down there. That would be probably the toe fungus.
All right, when we come back, the countdown is on to key inflation data. We will tell you how it could change the Fed's rate plans. That's next. And by the way, a reminder, you can get the best of Squawk Box and our daily podcasts. Just follow Squawk Pod on your favorite podcast app, and you can listen anytime. We'll be right back. Right now, for a look at the Fed's rate path ahead of this morning's inflation data and next week's central bank meeting, we want to bring in Krishna Guha, Evercore ISI vice chairman, who heads the global policy and central bank strategy team. And Krishna, thanks for being here this morning. We've got this PCI number coming up. Between that and what we heard yesterday with some weaker than expected jobs numbers and weaker than expected, or jobless claims numbers, I should say, and weaker than expected GDP, what does this all add up to for the Fed?
Well, it certainly wasn't a great set of releases yesterday for the Fed, but I think that they'll be overwhelmingly focused on the inflation data. The growth stuff was weak at the headline level, but pretty solid underlying, with a little cooling in consumption at the margin. That's sort of what the Fed would like to see. But the inflation data is what the Fed does not want to see. So what we learned yesterday was that in the first quarter of this year, taken together, inflation was even hotter than we had previously understood. And we'll understand that a bit better when we get the monthly PCE report for March today. But it certainly confirms that things went the wrong way for the Fed in the first quarter.
Yeah, the two-year yield is reflecting that this morning, above 5% again. Where do you think rates are headed?
So look, I still think right now that the single most likely outcome is that the Fed is able to cut rates in either July or September and get another one done by the end of the year. But that's hanging by a thread. At this point, the Fed simply can't move forward until and unless they get a step down in the monthly pace of inflation that holds over at least, say, 2-3 months, so they can see a new trend emerging that's pointing back down towards 2%. So think maybe 3 inflation prints in a row with that month-over-month core PCE that they watch so carefully around 0.20, at least the very low 0.2s. Until and unless that happens, they're stuck.
So that's your expectation for what's going to happen today? If you think a rate cut is likely, you do think the PCE is going to come in at that level today?
Not today, because we already basically know what today's number is. It's going to be around 0.3. So why do we know that? Because this is March, right? And they've already given us January, February, and March together. So we can just subtract out some level for January and February and infer March. Now, we're going to learn today the distribution across January, February, and March. We're going to learn the composition of the inflation in March. All this matters. But the basic idea that March is going to print too high, we know that already. That's already in the price. The question is, do we step lower April, May, June, which is what we need to get going on rate cuts in July, or do we not? If that's not, we slip to September. That's a difficult meeting. It can go, but it's a difficult meeting right against the election and with bad base effects. And more broadly, if the inflation does not step down over the months ahead, the Fed will at some point have to make a deeper, more fundamental reassessment of the inflation dynamics in the U.S., how much work they've done and how much they need to do going forward. They will hope to deliver whatever is needed by staying where they are for longer. I don't think anyone inside the Fed yet is actively considering the possibility of rate hikes in the way the market discussion is. But at some horizon, far enough into next year, if you're not seeing what you want, in particular, if inflation were to accelerate back up again above 3, say 3.25, that's when rate hikes could come back on the table. Not now, possibly later.
Krishna, at the risk of kicking back up a conversation that just died down around the table, what do you think of the Wall Street Journal story that says advisors close to Trump would like to draw up plans to rein in the Fed's independence? The idea of making a mandatory litmus test that any candidate for Fed chairman would have to agree to consult with President Trump before making any changes to interest rates and beyond.
I think that would be a seriously bad idea. And I think if anyone tried to move forward with that, the bond market and the stock market would make it very clear what a bad idea that was. Now, I think what I hope that former President Trump will understand, what I hope his more sophisticated advisors will tell him, is having an independent Fed would help you achieve your goals. Having an independent Fed has credibility. That means bond yields are lower. It means the cost of funds for your government is lower. It means the market and investors have more confidence, which means the stock market is higher. That's a gift for any president. It would be a gift for President Trump. And you would be insane to hurt yourself and your own administration by undermining Fed independence.
Well put. Krishna, thank you.
Anytime.
Okay, coming up on the other side of this, ExxonMobil CEO Darren Woods is going to join us in an exclusive interview. It's going to happen at 7:30 this morning. That stock's slightly lower after earnings. We'll talk to him about those. Plus, key inflation data that's coming up at 8:30 a.m. Eastern Time. We're coming right back right here on Squawk Box on a Friday morning.
The trial.
The Reverend Cecil Williams has died. He was the longtime pastor of San Francisco's Glide Memorial Church in the Tenderloin neighborhood there. Williams was a well-known ally of the LGBT community and a civil rights leader. Under his leadership, Glide became a haven for the homeless and marginalized in San Francisco. For many years, investor Warren Buffett raised money for the Glide Foundation through his annual auction for a personal lunch date. Buffett first met Williams when his late wife Susie volunteered with Glide's free meals program. In comments to Alex Crippen of the CNBC Buffett Watch, Buffett called Cecil Williams one of the greatest thinkers of our times. He said about Williams' work, "What you knew was that this guy is going to come through for you no matter what your troubles were. If you needed a place to sleep, if you needed medical help, if you needed a job, they will try to educate you for it." Buffett said Williams should have received the Presidential Medal of Freedom. He certainly deserved the medal more than a lot of other people, Buffett said. I'll put it that way. Cecil Williams was 94.
Coming up, we're going to show you what Intel CEO Pat Gelsinger said about the disappointing guidance that is apparently weighing on the stock this morning. Way back in 32, round trip. Swap Box will be right back.
Driven together. We delivered a very solid Q1. We met revenue, we beat on EPS. We gave a outlook for first half to second half, a much stronger second half outlook, as we saw with growth across every business forecast for the second half. And somewhat like the market indicates, maybe a little bit of market weakness in the first half of the year. So we're working through that.
That was Intel CEO Pat Gelsinger speaking to John Fort. The chipmaker reported mixed results and offered a weak guidance now for the second quarter. Want to bring in Wolf Research senior analyst Chris Costello. Okay, so for some analysis on this whole situation, because you look at the stock and it has been an underperformer. Maybe that's putting it politely, Chris.
Yes, and we have an underperform rating on the stock. For the quarter itself, there is some weakness here in the first half of the year. We've gone through the inventory correction that we had last year, but just the end markets haven't come back as strongly as perhaps Intel would have hoped in both the server and the PC side. There is some gross margin pressure as well. But really, I think what's really important for the stock is something they said at the beginning of the month when they gave some details about the manufacturing business. And the disappointment there was that the manufacturing part of the business wouldn't get to break even until 2027, and that's a lot longer than people had hoped for. What's happened here is that Pat Gelsinger has done a very good job in fixing Intel's manufacturing. The problem is that comes at enormous cost. And, what's happened in the 4 years since they started this is the market's changed, and the change was obviously AI. And Intel's not participating fully in that. And the rest of Intel's market, such as the traditional CPU server business, just isn't growing fast enough to cover the massive manufacturing costs.
And so, Chris, I think there's two questions. One is, will it ever grow fast enough, or is the need for even faster chips going to make those chips that they're making effectively obsolete? And the investments that Pat Gelsinger is making today, do you think they ultimately actually will pay off, or that somebody else is already going to leapfrog them again?
Well, there's still going to be growth in the traditional server market, just not as much growth as there has in the past, because more of that money is flowing to AI and GPUs and specifically NVIDIA. What they hope now is that the other business they're putting on top of this is a foundry business where they would compete with TSMC. And it's far out in time, that's kind of, 27, 28 before that business really gets going. It's very uncertain. TSMC is a very strong competitor. And, when they started this journey, the foundry business, at least from an investor standpoint, was looked at to be optionality. It's not optionality anymore. That's what's needed to drive profitability for Intel.
So what do you think this company should be worth? Stock right now trading at $32.46.
Yeah. So our price target now is $29. What in some of those disclosures they made at the beginning of the year, the metrics they provided, gave you, the hope for, somewhere in the range of $4 of earnings, but, kind of far out in time. I think it's sort of a 27, 28 event right now. For right now, our preference is, for some of the faster growing parts of the market, NVIDIA, AMD, Micron and memory, where they're fully participating in AI right now. And the problem you have also with semiconductors is it's a cyclical business. So by the time you get to potentially the payoff on Intel in 27, 28, we could be going through another industry downturn. So our view is, it's a stock that we take another look at, after we're through this cycle, perhaps into the next cycle.
In terms of, finally, just real quick, stack rank, if you will, the chip stocks or the chip companies on our screen. We got Intel, NVIDIA, Qualcomm, and Advanced Micro. I don't know who else you want to throw in that mix. If you were to stack rank them in terms of how you'd want to own them or not, tell the viewers.
Right. So NVIDIA is our top pick. It's been our top pick for a while for obvious reasons. We think there's a lot of legs to go in AI. We like AMD as well. We think AMD is the number 2 to NVIDIA, just like they've been number 2 to Intel for a long, long time. We like Qualcomm also on, the prospect of a handset recovery, but, what I put even higher on that is, again, AI-related names such as Micron, that for memory, and then the semi-cap equipment companies like Applied Materials that provides the equipment for that.
Chris, I want to thank you for joining us this morning. Have a great weekend.
Thank you, too.
You bet. It is just about 7 o'clock right now on the East Coast. We're watching Squawk Box right here on CNBC. I'm Andrew Ross-Sorkin along with Joe Kernan, Becky Quick. Today's top story is J.P. Morgan Chase CEO Jamie Dimon now reiterating his skepticism around the potential for the U.S. economy to achieve a soft landing. In an interview with the Wall Street Journal, Dimon cautioning that investors are too optimistic, citing sticky inflation and interest rates. Meantime, U.S. Secretary of State Antony Blinken met with Chinese President Xi Jinping early this morning. Xi telling Blinken there has been some progress in the months since his meeting with President Biden back in last November, but there are still many issues that need to be resolved. And also, Walmart now saying that Rob Walton, the eldest son of founder Sam Walton, the longest-serving member of the board, is stepping down. The company has nominated Chipotle CEO Brian Niccol to replace him.
Right now, let's get a check on the futures this morning. We've been in the green all morning. Dow futures at this point up by about 37. They've pared their gains. That does come after we've seen some weakness from some of the oil companies that have come out with a little lighter than expected numbers, either on the top or the bottom line. S&P futures right now up by 36, and the NASDAQ, with some strength from stronger than anticipated earnings from a lot of tech companies last night, is indicated up by about 180. Right now, we want to get over to Dom Chu. He's got a look at this morning's pre-market movers. And Dom, these earnings keep rolling in.
Yeah, and let's start, Becky, to your point, with the two biggest influences on the best performing sector in the S&P 500 so far in 2024, and that's energy. So the late-breaking energy earnings news for both ExxonMobil and Chevron are maybe to the downside, more decidedly so. ExxonMobil is down 1.5%, Chevron's down 1%. We'll start with Exxon, which is trading on just about 30,000 shares of volume. This is America's biggest oil and gas company by market value. It reported profits that fell shy of estimates on better than expected revenue, so mixed. Exxon was hurt by lower nat gas prices and smaller profit margins for its refining operations. Now for Chevron, it was also mixed, but with profits better than estimates on revenues that fell shy of the mark, also hurt by smaller margins for refinery operations and lower nat gas prices. So both of those shares lower. We will get much more on both of those stories later on this morning and this hour specifically when ExxonMobil CEO Darren Woods joins the Squawk Box team for an exclusive interview later on this hour. And then in the 9 a.m. hour on Squawk on the Street, Chevron CEO Mike Wirth joins for a CNBC exclusive interview as well. So two CEOs for two of the world's biggest oil companies coming up. A big morning mover on the earnings front from last night's close is Snap Inc. This is the parent company of social media platform Snapchat. It's up roughly 25% in extended trading, over 320,000 shares of volume. It reported a surprise profit per share on revenues that beat expectations. Revenue growth actually spiked to 21% for the quarter, and that snaps a streak of 6 straight quarters of either just single-digit growth or outright growth declines. Though that growth was powered by better performance in its advertising platform, so Snap is up big 25%. And we'll cap things off with an interesting analyst call on the automotive side this morning, and that's Sonic Automotive. Shares are higher by just about 5.5% right now on thinner pre-market trading volumes. This is an auto dealership company. It's getting upgraded over at Bank of America by 2 notches. It's now buy rated versus a prior sell rating. The target price goes up to $68. It was $55. They're citing, amongst other things, a bottoming out and turnaround for Sonic's Echo Park used car dealership platform. And by the way, if you're interested in that call, head over to cnbc.com/pro. Subscribers there can get access to that and other top analyst calls of the day. Becky, that's the state of play right now. I'll send things back over to you.
Dom, you mentioned Sonic, and now all I can think about is cherry limeade and tater tots.
Different kind of Sonic, right?
Yeah, I know.
I'm thinking about putting Fritos in everything from burritos to
Wrong kind of
burgers.
Sonic. Yeah,
I think you one right.
Thanks, Dom.
You got it.
Let's look at some of the technicals in the market. Joining us now, Chris Ferrone, the TDS Research Partners Head of Technical and Macro Research. And says here, and I'll take your word for it, that you were talking about a correction earlier this month in April, and that was different. You guys at your shop, you can think whatever you want. You don't need to agree with Jason Trenner all the time, right? So you weren't looking for a correction long before April 2nd?
Well, I think as we kind of moved through March and, you know, the incredible strength to start the year, by the time you got to late March, early April, there were some weird things that were happening, right? We saw the move in yield. We saw dollar go along with it. You started to get this little streak of counter-cyclical leadership, right? The staples started to get some life breathed into them, the utilities as well. That just didn't feel right for a market that was up 10, 12, 15% year to date. And we kind of put out the watch your back tactical caution call. Now, I just don't want to get too cute with that call, because at the end of the day, the primary trend of this market is still up. And when you get 5, 6, 7% drawdowns in uptrends, you generally want to be a buyer when the oversold conditions start to present themselves. And I thought last week we started to see some of that, Joe. We had a surge in the number of stocks making 1-month lows. When you start to get 50, 55, 60% of the index making a new low, you're generally in the ballpark of a good tradable bottom. So I think we're close. I don't know if yesterday or last Friday is going to be the low, but I think we're close enough in the context of a bull market to be putting risk back on here.
Because earlier this week, that was the consensus, I would say, that we were hearing, was that, look, we were expecting 5 to 10%, and you know, now it looks like we've wrung out enough of the sentiment has turned bearish enough, and then, you know, all of a sudden you get that GDP number combined with a hotter, you know, or rekindled inflation worries. And at one point we were down a lot yesterday. You know, we came back quite a bit, but it shook people a lot. It looked like we could still be in a pullback mode? You think we're close to the end of the pullback?
I think we're at the end or near the end, and I just want to remember, corrections don't end on good news, they end on bad news, right? It's bad data that emboldens the bearishness out there, which is where the correction lows are often made. I thought something interesting happened last week. You had spot VIX beginning to trade above the future contracts. That's a sign of stress. You began to see some stress in the put calls. I thought a lot of the survey data that we got this week was interesting. The bullishness has really come out of this market. So I think the sentiment story is coming together, and maybe what's gone unappreciated as this market has corrected, how well these financials have acted. I mean, the leadership from the bank stocks, the brokers, and not just domestically. The European banks have continued to chug along, even the Japanese banks. So there's a good streak of kind of financial leadership that's emerged out of this correction. And you always want to look to, in a corrective phase, what are the leadership clues that the market's offering? They tend to come out the other side as pretty potent. And I think financials and banks in particular check that box.
Especially after some of the angst is about rates staying higher for longer.
Yeah.
But that can help and hurt the financials.
I think
the banks.
Yeah, Joe, I think it's less about the nominal level of rates. What's happening quietly is the curve steepening. And look at 2s, 10s. We've gone from negative 45 to just about negative 30, negative 28 right now. My suspicion is that's why banks and utilities are kind of working together here. That bear steepener generally good for both groups.
Okay. All right, Chris Verone, thank you.
Thank you.
Okay, when we come back, Google and Microsoft riding the AI wave. Google handily beating expectations, delivering its first ever dividend, while Microsoft cloud growth accelerating on the back of its AI push. We're going to talk about both of those names next. And then later, ExxonMobil CEO Darren Woods is going to talk quarterly results in the energy markets. Squawk Box coming right back.
Microsoft and Alphabet both reporting better than expected results, and both accelerating their AI strategies, which is still, I guess, good. Steve Kovac, sometimes they can turn bad, joins us with more on how AI is impacting both tech giants. You got to spend money to get there.
And not just some money.
But then when you start spending too much, there comes a day.
Yeah, and there is going to be more spending. We can talk about that in a minute. But right now, let's talk about these two monetization stories on artificial intelligence these two companies have been telling. But it's clear right now, we're still in the very early days and not a lot of disclosure from either company on what's working. Just some promising nuggets of information showing both companies could be on the cusp of something big. For Microsoft, we saw the AI sales in the Azure cloud unit. It contributed 7 percentage points of the overall 31% year-over-year revenue growth. That's up from 6% quarter-over-quarter. But that's where the AI story kind of ends as far as monetization goes. There was lots of mushy talk from CEO Satya Nadella on Copilot. At the end of the day, we really have no idea how well it's selling, but some little nuggets of information here. Nadella did mention a handful of companies, we're showing them here, that bought at least 10,000 subscriptions to Copilot. As for Google and Alphabet, CEO Sundar Pichai shot back at the idea Google's core search business was under threat from chatbot search engines like the one from the startup Perplexity. He said tests showed early increased usage in AI search. If that pans out, that is, of course, more chances to stuff ads in search. And beyond ads, Pichai said Google will monetize AI through subscriptions and, of course, the cloud, just like Microsoft's doing now. One other interesting argument from Pichai, though not related to AI, he did say YouTube and Google Cloud combined will have a $100 billion run rate this year. That's kind of his way of saying Alphabet's more than just selling search ads, guys.
Right. Yeah, it's probably not, I was saying like streaming. I said that earlier. Remember how streaming, everybody, we're going to spend all this money on streaming.
Yeah.
And Disney went to like $200 because streaming only got streaming. And then
Look at Peacock, look at Paramount.
A year later, it's like, how much money are we spending on streaming?
But that's nothing compared to what they're spending. I mean,
and the promise is exponentially greater for AI.
And this was talked about on the call. So I think it was Mark Mahaney from Evercore who asked this, or someone else, basically saying, you guys are spending so much on AI, what makes you think that there's going to be a payoff down the road? And they basically talked about how flexible they're being because they're managing, they meaning Microsoft, managing their CapEx based on the demand they're seeing. Because keep in mind, they run all the OpenAI stuff on Azure, huge demand there, so they have to flex to the demand.
When you think Graham and Dodd, the only reason to ever buy a stock is that you hope the cash flow from the dividend keeps increasing over time as the company does better. Why does anyone ever, that's one argument, why does anyone ever buy a stock that doesn't pay a dividend? You're not guaranteed of getting anything back.
We saw what happened with Alphabet there, and largely moved up because of that dividend.
Sometimes it goes.
Meta did it too.
Sometimes it goes the other way because it means the growth phase of the company is over.
But that's not what they're hinting at. They're hinting at we're on the cusp of the next growth phase because of AI, and then you have Pichai pointing to YouTube and cloud saying, hey, we're not just a search and ads business,
right.
you know.
But why pay a dividend then? Why not reinvest everything into?
Same reason Meta did it. It's giving the shareholders what they want. I mean, we saw how the stock reacted.
Yeah, I wouldn't give it back if I were them. So I like it too.
You want to keep it for yourself?
Yeah. Thanks, Steve.
Thanks.
Up next, the Wall Street Journal reports that Donald Trump's allies are quietly drafting proposals that would attempt to erode the Federal Reserve's independence. We've got that story next. Right now, though, as we head to a break, check out shares of Colgate-Palmolive. They are higher after the consumer products company beat the street's expectations on both the top and the bottom lines for the first quarter. You can see that stock up by 3.3%. Squawk Box will be right back.
For today's Aflac trivia question, which bank is credited with installing the world's first ATM? The answer when Squawk Box continues. AflacTrivia.com. And now the answer to today's Aflac trivia question. Which bank is credited with installing the world's first ATM? The answer, Barclays Bank in 1967.
Welcome back to Squawk Box this morning. The Wall Street Journal reporting Donald Trump's allies are now quietly drafting proposals that would attempt to erode the Federal Reserve's independence. That's if the former president wins a second term. A small group of Trump allies are arguing that he should be consulted on interest rate decisions, that Fed regulation should be subject to White House review, and that the president should more forcefully use the Treasury Department as a check on the central bank. The Journal saying it wasn't clear if Trump was aware of the proposals and that the work was so secretive that some prominent former Trump economic aides weren't aware of it. Joining us right now, Chad.
In the article, we're going to have the guy on. A long shot bid.
And so much more.
I mean, it makes about as much sense as bleach for COVID. And that didn't, ingesting bleach, that didn't last very long, right?
We're going to have Liz Hoffman on. If I can interview you if you'd like to.
Ask Liz. We're going to have Nick Timros on later, so we can ask him. But I just read the article itself, and it's not nearly as, the way we just characterize it there is that Trump allies are considering. And in the article, it says a small group of Trump allies that in a long shot bid.
You want me to read you the article out?
I already just read it.
It didn't say small. Donald Trump's allies are quietly drafting proposals that
sounds
would
like all of them. Some Donald Trump, some crazy.
Doesn't say some. To erode the Federal Reserve's independence if the former president wins a second term in the midst of a deepening divide among his advisors over how aggressively to challenge the central bank.
I think it's going nuts.
And I just want to make one other comment that the spokesperson, as we said, said this is not official, but did not condemn it, not say it's 100% wrong.
Did he say he had heard about it?
Absolutely insane and crazy. He didn't say that.
Right, but did he say he knew about it?
They did not, but the point is, if you thought it was insane and crazy, you would say it's insane and crazy. Liz Hoffman, is it insane and crazy? From Semaphore and a CNBC contributor.
We know it's insane and crazy.
Yes. Yes. This is pretty insane. I mean, look, the entire system, the entire model rests on Fed independence. And, in the last Trump administration was pretty publicly critical of some decisions and really started to, I think, undermine that. And then, in the intervening 4 years, mostly for policy reasons, the Fed has, I think has a bit of a credibility problem. And if you added politics to that mix, it seems incredibly dangerous to me.
Do you believe that this could even be a plausible situation?
I mean, I'm not a Fed lawyer. I don't know how kind of structurally it would work, but the idea that you would consult the president on interest rate decisions, and by the way, a president that has very strong, very public feelings about interest rates, really likes cheap debt, has talked publicly about that for a long time. He wants rates to be low, and there's policy times like the last 2 years when rates should not be low.
Liz, we all love the Fed, obviously, but there are Fed critics who have said there should be a Taylor rule, that no one should have a gut feeling that, it's transitory this time, we better go up this time, now we better go back down, now we better go back up. We got, how many different people weighing in on any given day. And so there are Fed critics that don't like the way it's being done right now. Now, obviously, an administration isn't going to be any better than an appointed Federal Reserve at figuring it out. But what about the whole idea that there should be a rules-based system for deciding how to do these things and not flying by the seat of the pants, depending on who gets installed as Fed head?
Look, someone's got to make these decisions. The Fed has gotten much more transparent over the years. You get a lot more information. You understand why they're making decisions that they're making. I think there's been a more robust discussion about what they got wrong. Certainly in Britain, they've done a real top five post-mortem. There's been talk about that here.
Some people say, shut up. Some people say you're all this, to say last time Jay Powell said, we're not there yet, but we're very close. Now we're not very close again. So I don't even know if the transparency.
I don't want to pivot off this issue yet because I just want to read you something. Whether it's explicit or something else, let me read you this sentence of this story. Some of the former president's advisors have discussed requiring that candidates for Fed chair privately agree to consult informally with Trump on the central bank's decisions. Others have made the case that Trump himself could sit on the Fed's board of governors on an acting basis. What does this say to you, and what do you think that the business community, some of whom have supported Trump last time and appear to be supporting him again this time, are thinking as they're reading this article this morning?
I think they're thinking it's incredibly dangerous. I mean, look, it seems tricky to accomplish from a legal point of view. There's lots of, the Fed works the way it works. But to your point, if the chairman has made some kind of private promise to the president to check in with him before making decisions, I mean, that's really going to unnerve the business and financial community who really trusts in the Fed's independence.
Can you imagine somebody who wanted this job before wanting it today?
Yes. Yeah, but I mean, look, working for Donald Trump has been, I would say, not always additive to people's careers, and people who came through the administration from the private sector, I think, have been kind of rebuilding their credibility for a couple of years in certain circles, and I would think people would be loath to kind of go through that again. That said, Fed chair is a very good job and a very interesting job for people who spend their life in the markets.
Liz, I want to thank you for jumping on this story this morning. I know we originally anticipated talking about private equity. You got a great piece in Semaphore, which I'd recommend everybody read. We don't have time to get into it in full, but I hope we have an opportunity to talk to you about that soon. Thanks.
Anytime.
The draw of power is always going to be there, I think. And you've seen some of those stories written too, that it's amazing who's still ready to serve. Some of the people that are on the list. At least I've heard anecdotally from people. I know some of them. We don't need to go into some of them, but people are willing to serve whoever happens to be sitting in that chair at any given time.
That's a cynical way of looking at it. It's you may be willing to serve your country.
That too. That you can always fall back on that. But it's you better know what you're getting into, obviously.
Yeah, and they've got 4 years to look at.
Yeah. Coming up, ExxonMobil CEO Darren Woods joins us to discuss first quarter results and much more. Futures at this hour are up a little bit. The Nasdaq's helping out, up quite a bit there, up 190. Squawk Box will be right back.
50% off.
When we come back, ExxonMobil earning $2.06 a share for the first quarter. That was a little shy of the street's expectations of $2.20. Revenue did, however, come in above expectations at $83.1 billion. Let's take a look at the stock. Right now, it's down by 1.4%. The CEO, Darren Woods, will join us right after this break. Squawk Box will be right back.
You.
Welcome back, everybody. ExxonMobil out with first quarter results this morning. The company earning $2.06 a share for the first quarter. That was shy of the consensus estimate of $2.20. Revenue did beat expectations, though, at $83.1 billion. And joining us right now for an exclusive interview is Darren Woods. He's ExxonMobil's chairman and CEO. And Darren, welcome. Thank you for being here today.
Good morning, Becky. Good to be here.
So why don't you talk a little bit about what happened during the quarter? So the stock is off by about 1.4%. Revenue was stronger than anticipated, but the earnings per share was below what the street was looking for.
Well, if you look at the business and our operations, they delivered exactly in line with our plan. In fact, in some cases, they outperformed. You can see that in our cash flow from operations, which exceeded consensus by about $1 billion. The miss the street had for our earnings are a function of some non-cash tax and inventory adjustments, which we tend to see quarter on quarter occasionally, and this quarter they happen to stack up. But we feel really good about the operations and what the business is delivering.
One of the highlights that you point out is the gross production numbers that you're seeing now in Guyana. 600,000 oil equivalent barrels a day there. I mean, that has turned out to be a hugely important stake for you.
Yeah, it's, I think, a great example of the capability of this organization and each of the different sectors coming together, our technology company, operations company, our projects company coming together to make these things possible. We deliver these projects at an industry-leading pace. We deliver them ahead of schedule, below budget. And when we bring them on, the operations teams start optimizing, and we tend to reset what we think is possible and very safely raise the production to a point where we are now running those 3 ships, those production units at a rate higher than what we made the investment decision on. So extremely proud of that. Of course, we've got 3 more in the works to feel really good about. So this is a tremendous example of what the organization is capable of doing.
But the production that you've seen in Guyana is, I'm sure, part of the reason that you're involved now in this arbitration with Chevron. Chevron wants to buy Hess. Hess is a 30% partnership in that deal with you. You guys have a 45% stake in it. What's the arbitration over, and what do you think is likely to happen here?
So I think great context for that discussion. And if you look at Guyana and the development there, I think it will go down as one of the best deep water developments in the history of the industry. So a lot of value that's been created through the hard work of the partners, but specifically with our engineering organization and our projects organization. So understand why Chevron's interested in participating in such an attractive development. The partnership that exists today is run or defined by a joint operating agreement. That agreement gives existing partners rights when there are changes in controls. The Chevron Hess transaction ignored those rights. We're standing up for the rights to make sure we protect the value that we've created there, to make sure we understand what the Guyana assets, the value of those assets are in the Chevron Hess transaction, and make sure that we have a line of sight to how best to optimize value for our shareholders.
I'm sure you understand Chevron's position. I'm sure they've explained it to you. They are saying that there's a Hess subsidiary that won't change, and they think that that is enough to satisfy what they're calling a contract language dispute that they think is something that's routinely put in and usually is not taken up by the other partners. How is this different, and how do you think it'll play out?
Well, I am familiar with their argument and their interpretation. We wrote the JOA, so we have a pretty clear line of sight as to the intent and the circumstances that apply, and the language that applies to these circumstances. So we feel pretty confident in our interpretation, and frankly, that's the point of the arbitration. The JOA allows for that. It's understandable that partners from time to time can have a different interpretation of that. We'll take it through the arbitration process, and we'll let the facts speak for themselves.
Would you put in a bid yourself if arbitration allowed you to do that? You guys are still caught up with Pioneer Natural Resources trying to digest that major acquisition. Would you have the money to go ahead and try and put a bid in for these assets as well?
I've made it clear in the past that this is not a play for Hess. We're not interested in a transaction on Hess. This is really around protecting the value that we've created as part of that development, making sure that the preemption rights that we believe exist in the JOA are recognized and confirmed, and then understand what the value they're putting on that asset is, and then what the options are to maximize the value to their shareholders. So
what does that mean, Darren? I'm sorry, just to dig into it, does that mean you're not looking to buy Hess outright, but you would be looking to buy these assets, or you just want to be compensated and maybe push for a higher deal for those assets where you guys are compensated as well?
I think there are a lot of options on the table, Becky. I'm not limiting myself to any one. We're going to look and see what the cash value of that. First of all, we'll confirm the rights of preemption, and then we'll look to see what the cash value of this asset is within that transaction, and then we'll explore the opportunities that are available to us.
Darren, while you're here, definitely want to talk to you about what you're seeing in the demand for oil these days. We've gotten a few concerning numbers. That GDP number that was below expectations yesterday. There was a lower than expected manufacturing index number. Are you seeing any sort of a slowdown, and what do you see on the global stage?
No, I would tell you actually the first quarter was stronger than, frankly, we had anticipated. And so the first quarter looks good as we look forward through the rest of the year. Our expectations, we're going to see demand growth for oil. Probably hit another record this year. Last year hit a record. This year we expect it to hit another record. Transportation fuels demand is very healthy. In fact, if you look at the first quarter refining margins that make petroleum products from crude, it was the second highest first quarter margin we've seen over the last 10 years. So a very constructive first quarter for refining. We're in a dip now as we head to the transition to the summer driving season. So we'll see how that picks up going in. Nothing indicates that that's coming off. The crude markets look fairly well supplied, but balanced. Natural gas is a little long right now, but I think that's a short-term issue. The one market that we see some weakness in from a margin standpoint is chemical, and it's not a function of the demand and the demand growth, it's a function of the supply that's coming on. So frankly, we see a relatively a positive outlook for the businesses that we're in our industry.
You know, the geopolitical concerns have been a huge issue. Both Jamie Dimon this week and then Mike Wirth, spoke with him about it. They both think that they're kind of surprised that you don't see oil prices higher because of what's happening on the geopolitical stage. How about you?
Yeah, I think it's, we've demonstrated, the industry's demonstrated the ability to respond to a lot of disruption. So inventories are fairly low, and that generally leads to higher oil prices. I think there's the potential for that to happen, but I think to the credit for the industry, we've responded well to the things that we've seen and continue to supply products the world needs fairly reliably, fairly consistently, and I think there's a level of confidence that the market's baked into the numbers. If we lose that confidence, if those disruptions begin to manifest themselves differently, we may see things change pretty quickly, frankly.
Darren, earlier this year, you talked to us about a suit you brought against shareholders. These were some activist shareholders that were trying to put a proposal on the proxy to speed up climate change actions at ExxonMobil. You all sued them and said basically they're just gadflies who are really slowing things down. They withdrew their proposal to have it put on the proxy, and you all continued your lawsuit. Where do things stand right now?
Well, I think the specifics of the lawsuit and the two activists that were masquerading as investors are just a symptom of a much bigger problem. The process that we have today is broken. The U.S. has, one of the, I think, shining examples of the world of shareholder democracy. And that process, though, is being corrupted with activists who are bringing an agenda into the proxy process. And frankly, an SEC that's not following its own rules. And so that shareholder suit was really to try to make a bigger point and to win on a bigger issue, which is trying to bring this back, the process back into line with the rules that exist today and make sure people are following the rules and the rules are being enforced. Frankly, we're fighting for shareholder democracy here to make sure that the system works as intended rather than let it be abused. And that's what the case is, what we're fighting for in this case.
And you guys aren't pulling any punches. I mean, you're asking for legal fees and expenses to be reimbursed too. You want to send a message with this.
I think when you have groups that are taking advantage of a legitimate process and frankly depriving people who want to use that process legitimately of their rights, there needs to be action and consequences associated with that. We had a very similar situation with the plaintiff's attorney with the Pioneer transaction where they filed a suit to try to block that transaction and the vote without some type of payoff. We took that suit to court, we won, the judge sanctioned that particular attorney. So I think that trying to stand up for shareholder rights is an important part of the process and how we think about our obligation here.
Taking things seriously, and you're not going to put up with it. Darren, let me ask you about some of the protests we've seen on college campuses. We've seen them here in New York, down in Texas, where you are, across the country. I know you watched the show yesterday. I just wondered if you had any thoughts about what you're seeing on these college campuses.
Well, when we look at recruiting and bringing people into the company, we're very focused on the fit of the individuals, the culture that they bring, the values that they bring. We believe strongly in the value of diversity and diverse thinking and challenging one another to kind of open our aperture and make sure that we're exploring every angle of an opportunity or an issue and that we're addressing it with the best input of all those involved. But that requires a level of respect and understanding. I think what we're seeing on campuses today in some places is something very different from that, harassment and intimidation. I think there's no place for that, frankly, at those universities, and certainly no place for that in a company like ExxonMobil. So we wouldn't look to bring folks like that into our company, and if that action or those protests reflect the values of the campuses where they're doing it, we wouldn't be interested in recruiting students from those campuses.
Darren, I want to thank you for being with us today and for talking about such a wide range of issues. Darren Woods.
Sure.
Appreciate
Thanks,
it.
Becky.
Coming up, financials in focus, a closer look at that sector. And then Dr. Scott Gottlieb on AI's push into healthcare and what that could mean. We're coming right back.
And make it count.
Welcome back to Squawk. The financial sector has been an outperformer this year, and it's top of mind as investors gauge the path of rates. Don Chu is taking a closer look this morning for this month's Sectornomics. Good morning to you, Don.
Hey, good morning, Andrew. Would you believe that the financial sector is actually the third best performing sector in the entire S&P 500 so far in 2024, behind just energy and communication services? So that sector in focus is a huge one for investors with this focus on interest rates. And again, 1 year over the last year, it's still up about 26%, so pretty decent for this particular sector. With regard to those investors who are looking for dividend yields in this kind of a sector, it's been a big part of that story. We screened the S&P 500 financial sector and looked at all of those stocks that have been outperforming or been in line with the sector over the last 12 months. So again, solid or better performance than the overall sector, and looked at the largest dividend payers in that sector. Among those names that have bigger than expected dividend payments for the sector overall and relatively positive price performance versus the sector, check out names like KeyCorp, which has a 5.6% yield, also Comerica 5.4%, Truist Financial and Citizens Financial at about 5% as well. So each of these names on the regional bank side have higher than average dividend payments alongside some relative strength as well overall. So when it comes to financials, at one point over the last 20, 30 years, they were very much viewed, those banks, as big dividend payers. the financial crises and a lot of readjustments for the banking system, regulatory-wise overall, have taken that narrative a little bit out. But Andrew, keep an eye on some of those names because they're back for some as dividend payers. I'll send things back over to you.
Dom, thank you. Talk to you very, very soon. Thanks.
Thanks, Andrew. When we come back, Moderna and OpenAI collaborating to potentially change healthcare. Dr. Scott Gottlieb will join us next to talk about this. Plus, a big inflation number ahead of the open that could give more clarity to the Fed's rate path. The personal consumption expenditures data will be released at 8:30 a.m. Eastern, and we will be on top of it. Squawk Box will be right back.
Jim's Club.
Moderna is betting big on artificial intelligence. The biotech company has joined forces with the creators of ChatGPT, OpenAI, to expand its employees' access to AI chatbots. Joining us right now to talk about the AI medicine revolution is former FDA Commissioner Scott Gottlieb. He is also a CNBC contributor, and he serves on the boards of Illumina and Pfizer. And Dr. Gottlieb, we should point out that you're an expert yourself in this. You're launching your own company this week, Zyra, which is an AI-based drug developer that you all have raised $1 billion for.
Right, backed by New Enterprise Associates, a venture capital firm where I'm a partner. Look, I think that the drug developers have been making use of AI tools for a very long time. If you look back even 20 years ago, they were making use of machine learning to do in silico drug design, basically design molecules on computers, and also using modeling and simulation to do dose finding. What's different now is the use of large language models, not just for enterprise-level SG&A functions, but also in the drug discovery and drug development process. And so you're seeing the large drug makers try to get instances of large language models within their own ecosystem so they can now load their own data on it and use it in a proprietary fashion. I've seen a lot of drug makers partnering with Microsoft. It's interesting to see them also partnering with OpenAI to do the same thing. I think the real next inflection point is going to be when you can build very high quality clinical data training sets to design models that are purposely built to solve for human biology. Right now, we're using models that are borrowed from the consumer tech world, so they haven't been built to solve for human biology, and we don't really have good clinical data training sets. And that's the goal of the startup that we're funding, is to try to build models that are purposely built for biology.
Meaning models that are based on biology itself, or models that are based on studies that have been done over 15, 20 years on all kinds of ways that these things play out? Like, how does it actually work?
Yeah, both. I mean, what's happening now is a lot of the data that we have to train models on, first of all, we're using consumer tech models, and then the data that we have to train those models on hasn't necessarily been collected in a fashion where it's optimized for training an artificial intelligence model, a large language model. So you might have proteomic or genomic data, but it's not correlated with phenotypes. Yeah. What we're going to try to do is do large-scale experimentation where we basically do perturbations at a very large scale. So think of changing genes and trying to figure out how it correlates with different phenotypes in the human body. So we have technology to do that. And when you do that at a very large scale, and you might even change genes in ways that don't exist in nature, you start to get a really good sense of the biology of different systems within the body, and then you can both build a model based on that information and train it more adequately.
Because so many of these clinical tests fail in the phase 2, phase 3 studies on this. It shows great promise, but you can't get through the requirements that these tests are showing. Do you think we'll have better ability to more quickly get drugs to market?
I think we're both. I think, first of all, these tools are being used in different portions of the drug development process to try to bring efficiency. So something as simple as trying to pull together the application that you're filing with the agency, or looking at post-market data to monitor for adverse events and try to figure out causality from signals that you're identifying in the market. But it's also going to allow us, if we can truly understand biology of different systems and different disease states, it might allow us to identify targets that we wouldn't have perceived otherwise, because we might see something adjacent to where we were looking that's also impacting a disease state that the model's pointing us to, and then to design drugs that we might not have been able to do experimentally. So Zyra, the company I'm involved with, is going after protein-based drugs first and foremost. That's going to be the first target. Right now, for antibody drugs, we use experimental models like mice, where we have mice that replicate human immune systems, and we basically try to get the mice to produce antibodies and extract them. So it's a hit-or-miss process. Using an AI model, and this technology has been developed by David Baker at University of Washington, who's also a co-founder of the company. Using this model, you can try to design antibodies intelligently that bind to protein targets that you might not have been able to get antibodies to bind to before, because antibodies are the sum of small interactions, and sometimes it's very hard to figure out how to design an antibody to bind to certain targets. If you can't get a mouse to produce that particular antibody, you can't isolate it from a person.
How long before you actually see this stuff helping in the marketplace?
Well, we're seeing it already. I mean, other companies are already using these tools. I think, again, the inflection point is going to be when you do things more deliberately, when you instead of borrowing some of the models that have been developed for more of a technological application, you can actually develop models that are based on human biology and based on training sets that were built for the purpose of designing new models. And that's happening right now. You see things like what David Baker built, RF diffusion, which allows you to design antibodies to bind to different targets. You've seen what Google did with AlphaFold, which allows you to model the structure of an antibody. So we're seeing these tools being used already in drug development, but I think we're still at the early stages of this because we haven't done it in a deliberate fashion.
Scott, you think about metabolism and you think about all these processes, and we've been lucky at different times to find things that one gene could, it's got a mutation, go in and fix it somehow. But gene therapy and working on one gene is very rare. How many genes are involved in most diseases or conditions? Hundreds, thousands, or?
Yeah, you're getting right to the point.
I mean, right, exactly. The only way to understand the total picture of what you're doing and designing drugs to address it, I think about 15 years ago, up at the Cancer Center at MIT, they got rid of the guy who was running it and put in like a data guy, almost an IT guy, because the convergence of...
That is the point. Not only... Now you can look inside systems, the model might tell you different elements of biology that are all impacting a disease state. You might be able to target it with one drug, so you design a protein drug to hit multiple targets, or you might be able to design multiple drugs and provide them in combination that you might not have perceived otherwise without the model being able to give you a much clearer picture of what the biology is of the disease. Because we're focused in. We try to narrow our focus to try to find one causative feature of disease and then target that with a drug. That's historically how we've done it.
Yeah.
That's not how diseases arise.
No, never happened.
Scott, very quickly before you go, a lot of consumer concern about avian flu being detected in milk, in the nation's milk supply. Should I be concerned about drinking this? What's the impact?
No, you shouldn't be concerned. So what they're detecting is viral remnants of heat inactivated virus, and there's no reason to believe the pasteurization process. First of all, I wouldn't drink raw milk. I would never drink raw milk. I wouldn't drink it now. There's no reason to believe the pasteurization process isn't going to kill this virus. And if in fact they found live virus in milk, and I don't think they will, but if they did and they're looking, I'd be more inclined to believe it came through the bottling process and contamination on packaging than coming through the pasteurization process. What this shows you, though, the reason why FDA and CDC did this testing of milk is that USDA and APHIS and state regulators wouldn't allow them on the farms to do more widespread testing because they didn't really want to turn over those cases. And so this is a backdoor way to do on-farm testing. Instead of testing the cows, you test the milk. And what we're finding is this virus is much more pervasive on dairy farms right now than what we originally perceived. And so that's unfortunate.
Is that a scary thing that it could jump?
It's unfortunate because the more that we allow this to spread in mammals, the more we're tempting fate that this could evolve in ways that it could threaten humans.
And they're not letting people on because they don't want to cull the herds?
This is a historical problem. So when I had outbreaks of E. coli in romaine lettuce, my inspectors weren't allowed onto the farms initially, so I sent the inspectors to test the adjacent farms, the water running off from the farms that I thought the E. coli was coming from. There's always been a tension between human health people who would want to swab everything and animal health people who are worried about some of the economic implications and don't want federal inspectors on their farms. And you're seeing that play out here as well. This is a very clever move by CDC and FDA to test the milk as a way to identify which farms have outbreaks. Hopefully it forces the hands of agricultural officials to allow more broad testing.
Can I get any immunity from the milk, from the fragments of the H1? How do you know?
You're not going to get immunity from fragments of
What? What if it was a spike protein? What if I got a spike protein from an H1N1?
Because it would have to be transcribed into the protein. The protein itself would probably be inactivated. I mean, maybe, I don't know.
I think I'm going to keep eating Frosted Flakes.
You know, there's a vaccine, there's also antiviral drugs for this particular strain.
No.
Dr. Gottlieb, thanks.
Going it naturally. It's 8 a.m. on the East Coast, and you're watching Squawk Box on CNBC. I'm Joe Kernan with Becky Quick and Andrew Ross. Talking about top stories today. Oil giants ExxonMobil and Chevron reporting results. Says they're reporting new results. That's good. I mean, who wants the old results, right? Exxon saw lower refining margins in its fuel business as revenues beat forecast, but profit missed. Chevron, we saw something different, light sales, but better than expected profit. Downstream earnings were down in the quarter, but upstream, that's weird too. Downstream earnings were down, upstream earnings were up, as you would hope. Two other corporate giants were watching after reporting, Alphabet and Microsoft. Alphabet saw the fastest rate of revenue growth since 2022 and announced its first ever dividend. Microsoft saw more of its cloud growth coming from AI in the quarter. And then there's the shares of Snap surging in the pre-market, the social media company posting a quarterly profit versus an expected loss. The second quarter guidance was also ahead of expectations.
The countdown is on to the Fed's preferred measure of inflation. That would be the Personal Consumption Expenditures Price Index, or PCE. Steve Leisman joins us right now. What's the expectation, Steve?
Going to get to that in a second, but I got to parse this out a little bit, Becky. We learned yesterday of an upside surprise in first quarter inflation. We learned this morning what month or months the surprise happened in, and for economists and the economy, it matters. Here's the consensus Becky asked about, but it's before yesterday's number. We look for the PCE, the headline, to be up 0.3 versus 0.3 in the prior month. Year over year, 2.6, it's up a tick from 2.5. The core, the more important measure the Fed watches, again, forecast before yesterday's number to be unchanged, up a 0.3 versus 0.3, and the core ticking down, but all bets could be off. But we know something in there is likely wrong. Forecasters know the quarter overall is higher, not what month it happened in during the quarter. In other words, how far in the rearview mirror is this inflation problem that we're talking about. So the question this morning, whether January and February revised higher, or if a lot of the extra inflation is focused in March, meaning the problem is now and getting worse and not better. Bank of America writing, you know, regardless of the monthly trajectory, yesterday's inflation release was unambiguously bad news for the Fed. Well, markets have recognized this new reality, driving probabilities for rate cuts to new lows as they think about drive interest rates also to new highs. May, forget about it. June is forget about it. July, almost nearly forget about it. September is where the market now is focused with a 58% probability, but you know, another bad number could be down to even money. The one positive here is that contrary to some takes, yesterday's GDP report still showed decent growth. You take out subtractions for trade and inventory, that's a normal way to look at it. Look at the core of the economy, business and consumer spending. It was robust, just not as strong as some had forecast. Economists forecast consumers kept spending levels up in March. So we'll see if we have this persistent offset this morning. Decent earnings, decent economic growth, but somewhat higher inflation. And that's why this market goes down yesterday, and this morning looks pretty decent. Becky?
Okay, thanks, Steve. We'll see you in just a few minutes to talk more about it.
For possible effects on the markets, I want to bring in Elise Ossenbo. She's the global investment director at JP Morgan Private Bank. Good morning to you. I think we're all trying to understand what the numbers were yesterday, whether we're in a bad position because if you have GDP going down, you have inflation going up, that's almost like the worst place to be. I don't know if we're going to see what kind of number we're really going to see today. I'm actually wondering what the numbers are going to look like when you go back and look at January and December, and whether that's going to change things. But how are you looking at it?
Look, I think it's possible we get some upward revisions to the historical PCE data with the release this morning. Maybe that number comes in a little hotter than what consensus is calling for based on the full quarter data we saw yesterday. But by and large, just zooming out, we have to acknowledge that this is happening against a backdrop of what is still really solid growth. I know there was that headline miss on GDP, but when you look at underlying measures of like domestic demand, that continues to trend at a really strong level, and it's encouraging to us given how we're feeling about the equity market.
If you were to look at the equity market at the end of this year, where do you think we're going to end?
Base case, we're calling for the S&P 500 to end in the range of 5,200 to 5,300, which does represent pretty solid upside for investors from here, but continue to be really focused on finding alpha opportunities.
And how diverse, if you will, is that upside in your mind, or do you think that it's concentrated in a certain group of stocks?
Look, we believe that the leaders up to this point can continue to thrive and likely will participate in that upside, but what we're really focused on is a broadening of this strength, particularly in some of the more cyclically oriented segments of the economy, just given what you're seeing with global manufacturing data as an example.
Right. And you're not worried, I mean, historically when you walked into a presidential election, there's been a lot of sort of stagnation, just about everything, because there's sort of a, let's just wait and see.
Yeah, the uncertainty sort of paralysis, but I think we kind of have this benefit of knowing what we're going to get with either candidate, depending on how the election turns out. And when you look at history, both of them kind of saw double-digit S&P 500 returns throughout their presidential terms. So I don't think either is, you know, by and large, a bad thing for the stock market.
Hardest question you're going to have to answer all day today. Do you agree or disagree with your boss about a hard landing, given what he just said? He said that it's impossible. I think he said in the Journal, he thought it was very hard to have a soft landing right now.
Have you guys talked about that?
Oh yeah, we were actually speaking.
I didn't know if he consulted you this morning on what he was going to say, or maybe you were consulting him with what you were going to say.
Our base case remains that we will still see a soft landing in the United States, but as ever, just like how Jamie talks about being prepared for all outcomes, we continue to work with investors to make sure their portfolios have different positions that can kind of weather and navigate different outcomes as well.
So it's Jamie. It's Jamie. You mean Mr. Diamond, I think.
Mr. Diamond.
Okay. All right.
Mr. Diamond. You want to?
Maybe it is Jamie.
I was going to say, do you want to weigh in on what's going to happen if the Federal Reserve is no longer independent?
Or if we have 15 Supreme Court justices, that's what the other side wants to do.
I thought you guys didn't like talking about that.
Yeah, exactly. Right. No, anything that we read, we will take like that it's fact. And we'll talk about it until we realize we'll never talk about it again. But we'll talk about it for a while today, I guarantee it.
Sure.
You worried about, you up nights worrying about the independence of the Fed? or the 45% long-term capital gains rate? Which is worse?
Oh man, probably the 45% capital
I
gains
know,
rate,
I
but
know.
there's always a way to figure out how to navigate new changes.
And
so.
which is more likely? I mean, what if... Thank you. Coming up, former White House CHIPS coordinator Ron Chatterjee on the progress of the President's CHIPS and Science Act. Plus, we're going to get the Fed's preferred inflation gauge at 8:30 and find out what it could mean for rate cuts. Investors will be watching the PCE data closely for any signs of what Jay Powell may do in the future, assuming he's still Fed chief. Squawk Box will be right back. The vast majority of the manufacturing incentives from the nearly $53 billion CHIPS and Science Act have now been allocated. Yesterday, President Biden was in Syracuse, New York, to announce an agreement with memory chip maker Micron for up to $6.1 billion in subsidies. Joining us for where things stand now, former White House CHIPS coordinator Ronnie Chatterjee. He's a professor at Duke's Fuqua School of Business. It's good, as usual, it's good to see you. Professor, can I call you Professor? Where are we? How much have we done? What do you think about how much is left?
Well, you can call me Ronnie if you like, but we've accomplished a lot. I think that over the last 45 days, you've seen 4 major awards to TSMC, Samsung, Intel, and now Micron. And with that, 85% of that $39 billion you talked about has been spoken for. And that's a huge accomplishment for a program that really started in 2022. As you remember, there was a lot of concern over whether the government could execute on this program, whether they would be able to get the money out the door, and whether we would be able to build chip making again in the United States. I think we've seen really good progress, a lot of work to do, but we're on the right track.
I guess it's important at the same time that we're talking about this, we just are funding Taiwan, and I guess there is a pressing need for us to get prepared here onshore.
Well, that's right. If you think about the number of chips we produce in the U.S., the most advanced nodes, it's very low. I mean, we don't really produce much at all. And now, with the four major producers, Samsung, Intel, TSMC, and Micron, for the first time in decades, we have all the leading edge producers here in the United States. We're the only country that can boast to have all of the top manufacturers now with facilities in the United States. That's what the CHIPS program has accomplished. There are going to be a lot of work to do to build these factories, to get the workers we need to work there and be productive in the factories. But this is a great start, and relatively quickly in terms of the last 45 days, seeing these major awards. It'll help the United States on national security, as you mentioned, but it's also going to create a lot of jobs and economic prosperity here at home.
We always want to try to do that, obviously, Ronnie, but there are arguments on both sides of the government picking winners and losers, whether it's industries, total industries, or we're trying to transition here, transition away there, picking individual companies. You're always going to get some pushback from people that say that the government isn't very good at this. Do you agree that normally this isn't the best way, and maybe this was a unique circumstance where this makes a lot more sense to? I mean, it was a bipartisan bill when it finally happened. There were Republicans that voted for it.
That's right. I think the reason there was bipartisan support is because of the importance of computer chips to national security. I mean, Econ 101 says exactly what you're saying, which is that you want to make things where they cost the least, you get the most scale, and you get the best production, so we can all buy the highest quality products at the best price. When it comes to computer chips, though, if all of those are produced in just one part of the world, and we were to suddenly not to have access to those chips, that's a big national security vulnerability for the United States of America. So in this case, I do think it's important for the government to put a push behind the chips industry, not by supporting a single firm or just American firms, but being able to support across a wide variety of technologies, and also research and development, and not just in one state, but across the country. And you saw these awards in Idaho, Oregon, New York, Arizona, Ohio. So to me, that looks like laying a strong foundation for an industry, not picking winners and losers when it comes to computer chips.
Just ask you one more question along those lines, Ronnie. Let's say that you are buying commodity type chips where the level of security or even expertise is not what it is in other areas. If comparative advantage would make sense in terms of cost to make it somewhere besides onshore domestically, would that still make sense, or do you just blanket statement, jobs here, bring it back here, labor might be 2 or 3 times as expensive as it would be somewhere else? That totally goes against everything that we did for decades, where we try to get and it helped inflation-wise, long term. You just think a blanket statement, we're making them here, even if it's going to cost 2 or 3 times as much?
I think it depends on the industries that we are supporting and why we're making them here. I mean, you saw this during the pandemic. We had supply chain disruptions where we couldn't get access to some basic products and some really important inputs. You remember cars were sitting on the lots with dealers because they didn't have the chips. And when cars were in short supply, prices went up, and that actually drove inflation. So for some key products, some critical products like computer chips, if we're able to build that industry here in the United States, and we do that with sort of discretion and milestones around construction of factories, around production of chips, around the right technologies, I think that's a good bet for the United States of America to make. And I think that's why it had bipartisan support. And it's amazing to see now these major producers all locating facilities in the United States. That was not necessarily going to happen without the CHIPS Act. And it's amazing to see the $300 billion of private sector investment. So this is a public sector investment of $52 billion, but it's already leveraged to over $300 billion of private sector investment. That to me is a sign that the private sector is going to do things here in the United States, and they're betting on the chip industry here again too.
Well, I hate to admit, maybe it's going to work well, Ronnie. Maybe in this case, but let's just not. This the broad brush we can't use for all these things, and maybe it'll help Intel, get above a 10-year wherever it is. Last time it was 32. Ronnie, thanks, Professor. Thank you.
Thanks for having me.
Okay.
When we come back, breaking PCE inflation data that is due out at 8:30 a.m. Eastern Time. Squawk will be right back.
Welcome back to Squawk Box. A new Wall Street Journal report saying this morning that Donald Trump's allies are quietly drafting proposals that would attempt to erode the Federal Reserve's independence if the former president wins his second term. Joining us right now is one of the authors of this article, Nick Timiraos, chief economics correspondent for the Wall Street Journal, now known as one of the great whisperers around the Federal Reserve. Nick, tell us about this report. Tell us about how close you think Donald Trump is to all of this, or whether we're just talking about some, crazy people off to the side. What are we supposed to think here?
Well, Andrew, it's a good question. I think the challenge with this is that there isn't the normal campaign policy apparatus with the Trump campaign, and that was what we saw in the first term in the White House. I think whatever the different advisors or people around the president put in front of him has a chance of becoming policy, at least for that day or for that period of time. And so I think you have to take seriously what different people around the president are proposing or would like to propose to him, because if it's something that he wants to do, he can turn to them and say, yeah, let's do this. And so I think what you have right now, I mean, in some respects, the story is surprising because this idea that you would have, an arrangement with the Fed that is not the norm that we've had in the last 40 years. But on the other hand, it's not that surprising because look at what the first Trump term was like. This is what the president wanted to have. He wanted to have a Fed chair who he could call and he could say rates need to go down right now, or you need to stop raising interest rates. And so I think the challenge here is just who is going to be the Fed chair if Donald Trump has a second term? Who is going to be, the NEC director, the Treasury Secretary, because the personnel will be policy. The people who have these jobs will get to determine whether the institutional norms that have existed with the Fed continue.
I was surprised that when you saw a comment from the administration, rather than deny this was happening or say that they know nothing about it and that they would condemn it and it wasn't something that they were interested in, they didn't take that opportunity. Did that surprise you?
Not really. I don't read much into that. I think, like I said, there's just not a conventional policy process with the campaign, or really there wasn't much of a conventional policy process at the end of the first term. I think there are two, important differences from the first term if Donald Trump is reelected. One is that, when he took the presidency in 2017, the Fed had a number of vacancies. So he had an early opportunity to remake the Fed board. Now, he picked more of establishment figures like Randy Quarles and Jay Powell. This time, if you look at who he was nominating at the end of his first term, you had different, more idiosyncratic choices like Judy Shelton, Herman Cain. But this time around, Andrew, he won't have vacancies on the Fed board unless people leave. There are 7 governors. All the seats are filled. If nobody steps down, then it's a year before he gets one vacancy.
You did put one thing in it. You just said, you talked to someone, and you're right. I don't know who's in charge, and he's got some other things going on. That it's probably not as cohesive a campaign when you're due somewhere else every single day. But even in your report, you say, what is it? Let's be very clear. If it doesn't come directly from the strategy session, don't take it seriously. I mean, they said that, didn't they?
They did, yeah, they absolutely did say that. But, Donald Trump is talking to people right now about the Fed. He's interested in different views. He's thinking about this. He cares about the Fed a lot. He thinks a lot about interest rates. He knows what, 25 basis point increase in interest rates will do.
Right.
The second point I was going to make is
Republicans wouldn't go along with it. I mean, you also quote people in the article. There's 2 or 3 guys that said there's no way this would ever happen, and you got to get confirmation of anybody.
But he said he'll do it secretly too, and part of the story, Nick, which was he said that there was going to be an implicit secret arrangement made effectively between a candidate who would have to effectively pledge their allegiance to the president,
but then and then be confirmed.
Get confirmed and with a private secret deal that they're going to be talking to each other to basically get approval before they make these decisions. I mean, I don't know, Nick. I read the story and I thought, if true, this is outrageous. So why don't we start calling a spade a spade?
Well, I'm not sure. I mean, You're right. The person that the president ultimately picks to run the Fed, that is how the president gets to influence monetary policy. I mean, that is the institutional arrangement we have. And then the question about whether Senate Republicans would go along with this, when we started hearing about this some time ago, I started talking to Senate Republicans to see what they thought. And you can see, I mean, we put them in the article. The Senate Republicans I spoke to did not like this idea very much. But the question is, at the end of the day, if Donald Trump is the president and he has a several seat majority in the Senate, will he be able to get whoever he wants onto the Fed board and into the chair? That certainly seems possible. So I think it's something you have to take seriously.
I don't see how the Supreme Court is any less sacrosanct than the Fed. And you have, people on your side.
What you're saying is that the next Fed chair is a Manchurian candidate. That's actually what we're saying here.
You want 15 people on the Supreme Court to have 9 liberal judges.
I don't think that's at all.
Okay, some people do. Some people want to do that.
No, I think
so
there's
crazy.
frustration.
off.
All right, it is time for the March PCE inflation data. Rick Santelli is standing by. Rick, take it away. Markets up ahead of the number.
Yes, we are waiting for, of course, the personal income spending, all the associated inflation metrics. This is a March number looking for roughly up 0.5% on income, and it delivers up 0.5%, up 0.5% on income, up 0.8 on spending or consumption. And the 0.8 is definitely warmer than expected. It actually equals our last look, and our last look, that was the best since January of 23. So back-to-back 0.8% on spending. Of course, revisions still may be forthcoming. If we look at inflation-adjusted consumption or spending, called real personal spending, it's also up more than expected, up 0.5%. Up 0.5% equals December of last year. To find a bigger number, you have to go to January of last year. Now, let's look at the deflator, month over month, personal consumption expenditure deflator. Expected up 0.3, delivers up 0.3. In the rearview mirror, up 0.3. The deflator year over year, expected up 2.6. Our first number, that's hotter than expected, up 2.7. In the rearview mirror, still unrevised, up 2.5. To find a bigger number than up 2.7, you're looking at October of last year. Now, let's look at the deflator month over month, and this is a core number, expecting up 0.3. It is up 0.3. Back to back 0.3. Finally, the year over year core deflator, also another year over year number, and another one hotter than expected, up 2.8. We're looking for 2.7. This was a very talked about number, maybe the most talked about out of all of them, and it equals our last look, which was 2.8, and 2.8 actually was the lowest. To find a lower number, you're going back to March of 21, so back to back. The only issue is, and of course, I'm sure many will say, making huge progress. The reality is it's stalling, and that is the issue. Nobody's arguing that progress hasn't been made. The issue is, what have you done for me today? And we do see some of these inflation numbers remaining sticky, albeit at lower levels than a few years ago, which doesn't mean there's no inflation. There's just less of it creeping in every month. Becky, back to you.
Excellent recap, Rick. Stay with us. We're going to bring in a few more voices on this data. Stephanie Kelton is Stony Brook University economics professor. Allison Schrager is the Manhattan Institute senior fellow. And, of course, our very own Steve Leisman. Steve, why don't you dig through these numbers? Because there's a lot for people to get their heads around.
Yes, thank you, Becky. I'm trying to figure out how we got here, but I am seeing very modest upward revisions. I don't see out to the 100th place, which is where the action must have taken place. But let me just say, I think we dodged a bullet here. Went into the meeting, to this number with the following metric in place. 0.3 for March was good, 0.4 was bad. We got the 0.3. I do not see, and please correct me, Rick, if I'm wrong, I don't see an upward revision to February either. I see February still at 0.3, so that didn't change. Rick's assessment is 100% right. We have made progress. That progress has stalled. But what didn't happen, at least in the first iteration of this number, is we didn't get an upward revision or a higher than expected number for March. So to the extent that that quarterly number that caused everybody to freak out yesterday was higher than expected, it looks like it happened in January. Why is that important? Well, because we knew January was weird. We had a lot of seasonal effects in there, a lot of one-time price increases. So now we learned that January looks like it was worse than we had thought. But February and March, that sort of continued and didn't get worse, and maybe just very incrementally better. So I don't think this causes the Fed to cut rates in June or even July. I'm going to take a quick look at the futures market while I'm talking here. But I don't think it pushes further ahead the idea of rate cuts. And I'm looking here, Becky, kind of unchanged pretty much. Maybe a little bit more love for a cut in September, but only marginally so. We're still not going to happen in June.
And consumption were a bit hotter, though, Steve. The growth side of the economy a bit hotter. But you make a case for this actually does mean, why do we need rate cuts here? It seems as though the economy is doing just fine where rates are and inflation's still sticky.
I think that's a fair point, Rick, but I would also say the idea of the stag is not there in the stagflation part. My assessment yesterday of the GDP numbers was looking under the hood. I thought they were better than the first take made it appear, or than the headline number made it appear. You still had good core growth there in consumer spending and business spending, just not as hot as had been expected by someone on the street out there. So I think the story here is we still have this crazy offset, this Jekyll and Hyde story out there of inflation bad. We have to worry about it. Rate cuts not coming, but you have decent earnings and decent growth on the consumer side and decent growth. Rick, the question becomes, and I don't know the answer to this, and I appreciate your view on this, is does the economy have to cool below potential? Does unemployment have to rise in order to bring inflation down? We may be at that point, but we don't see this hotter consumer spending necessarily pushing up inflation, just not necessarily pushing it down.
Okay, let's
The
get some.
service sector seems to be where the inflation is. I'm sorry, we can get
Oh,
the
go ahead,
panel
go ahead,
involved.
Rick. No,
It's-
go ahead.
It seems though it's sticky.
Sticky. Okay,
You're
and,
right.
and I
Agreed.
think what you said is really, really important, Rick. This idea that progress is stalling. Stephanie, why don't you weigh in on that, because this is that last mile, and this is where things get really tough and really tricky.
Yeah, it is, and it is also important to remember that, you know, as we bump along and watch what's happening with inflation, we've got some idiosyncratic things that continue to show up, you know, these imputed calculations that are really prices that nobody actually pays, that once in a while come in and nudge inflation higher. We've got rent, which continues to be a lagging indicator. If you're looking at what's happening to leases that are being signed today, we still haven't felt the catch up from that. So yeah, there are reasons why things appear to be stalling out, but I think we can understand them. And overall, this continues to be a really good story about where we are in this economy. The consumer is strong, the labor market is good. I don't think it's a huge problem. Inflation is coming in line with expectations. We got a very good thing going here, and we're, you know, focused on second decimal points and whether we get all the way back down to 2% and talk about risking, you know, a very good economy for the sake of getting all the way back down to 2%. I think it's just
2.8 is more
what
than
you
a
just laid
decimal
out.
point
What
away.
you just laid out, this great economy, everything doing really well, is not an argument for a rate cut.
It isn't,
Bingo.
and I'm not making one. I'm not making one. I think we've gone from, you know, we don't talk about higher for longer anymore. I think we're talking about fewer and later. And I think that's what a data-dependent Fed is going to get from a reading of this data. I think that's a fair assessment.
Okay. Allison, why don't you weigh in on this? How do you see this playing out? What's it mean?
Well, I mean, I think in some ways it's imagine 20 years ago if we were talking about a rate cut in this environment where, you know, demand is strong, inflation's high, but, you know, not higher than what people were used to. And honestly, interest rates aren't that much higher than what people were used to. So I think Rick's right. This is pretty sticky. I mean, I think we can see that in high demand numbers. Certainly wages are still high. The fact that inflation is so much largely coming from services, to me, suggests this rate might just be in the bones of the economy. So the Fed is going to have to decide, is maintaining their target really worth potentially inflicting economic damage? Or are we just going to learn to live with higher rates and higher inflation?
Am I sensing a consensus almost that everybody, which would be shocking to me, everybody on the panel agrees the number's okay, it's not an argument for cutting rates, and we'll just have to wait and see? Raise your hand if you agree with that assessment. I got 2 votes. Rick and Steve, you disagree?
Yeah, you know, here's
I
my
think there's
problem.
scope.
My problem is yesterday's number underscored how much we over-evaluated GDP. And we could talk about income, which has been goosed by a number of issues. Well, wages, minimum wages, government involvement, that is an issue to put to one side. In terms of the spending seems to be doing pretty well all in all, but credit card balances are going up, various delinquencies are going up. So I think it's a dual speed. I think that yesterday's GDP numbers showed us we have much less growth than we thought. This number shows us that a lot of different programs and money sloshing around is still remaining, but the glide path is lower. So I disagree. I think that the anecdotal evidence I look at suggests the economy, the steam engine post-COVID, where timing has been off on everything and the Fed's models aren't working exactly right. It's slowing, but inflation isn't going away. I'm sticking to my stagflation story.
Steve?
I think there's scope for 1 or 2 cuts based on the Fed's own framework, which is that if you look at the idea that they had forecast core PCE for the year at 2.6%, it's run at 2.8%, and in that context, the Federal Reserve had forecast 75 basis points of cuts. I think the Fed is just a bit overly restrictive. The problem is that Powell has talked about rate cuts as a process. I think there's room to tweak at the top by 1/4 or even 1/2 point and still get the effect of a restrictive policy and take away some of the risk that Allison was talking about the possibility of engendering or creating greater weakness in the economy. So I think there's rationale for a tweak there. I do not think there's rationale for a process of cutting rates substantially lower at this point.
Hey, Rick, we actually just showed the yield on the 10-year ticked a little bit lower on these numbers. Does that surprise you?
You know, it does surprise me a little bit, but I think that being on a Friday where you had a big jump and many traders are readjusting to the landscape, that the real key is not where we're trading right now, but where we close the week. And I'll remain very focused on one level. If we close yields above 467-ish, I still think that our next major stop is going to be 5%.
Stephanie,
hey, Rick, can we say one thing? Becky, ask Rick one thing very quickly. A little bit off topic, but very important for our markets here. Rick, I'm seeing the yen 156, almost 157. People had talked about the idea that the BOJ may come in at 155. They've been kind of quiet. Are your guys down there in the pits bracing, thinking about, considering the idea that there could be some intervention here on the level of the yen?
They're not bracing, they're licking their chops. Okay, history dictates that traders moving against the Bank of Japan usually win that battle. And I think that's why the Bank of Japan is so remiss to once again relitigate the whole structure of intervention in an FX market.
Stephanie,
just want to put that on everybody's radar.
It's a good thing. I'm glad you did. We haven't talked about it much this morning. Stephanie, why don't I give you the last word on this?
Well, I was going to say something about Japan. I seem to remember the Widowmaker trade. I think that typically when investors bet against the BOJ, they lose.
Okay, we will leave it there. Stephanie, Allison, Rick, Steve, want to thank our panel for the roundup on the numbers.
Coming up, Bank of America's Vida Subramanian joins us on the markets. Post this data we just were talking about. Plus, we're going to bring you a rundown of some key stocks making news in the pre-market. Here's one to get you started. Data management software maker Rubrik. The Microsoft-backed company ended its first day of trading on the New York Stock Exchange up more than 15%. Stay tuned to watch the Squawk Box on CNBC.
BC Pro.
Welcome back to Squawk Box, everybody. The March PCE inflation data coming in hotter than expected year over year when you're looking at just the core. But if you were looking at the monthly numbers, they were in line with expectations of 0.3%. The futures taking all of this in stride. Right now, the Dow futures up by about 75 points, S&P futures up by 45, and then the NASDAQ indicated up by 190.
I want to get straight over to Dom Chu. I was looking at some other stuff this morning that is moving in the markets before we open up at 9:30. What's on the list?
All right, so Andrew, to Becky's point here, we did see a good amount of intraday volatility just around the release of that PCE data. And again, it affected mostly the interest rate markets. As you can see here, yields across the board are lower. So there's been a slight bid to the government bond market here in the U.S. Focuses on the 2-year note yield hovering just below 4.99% and the 10-year note yield just a hair above 4.67% as well. For those people who use ETFs to take views on the Treasury market, that so-called TLT ETF is up just about 0.5% as well. So that's the yield picture. The mega cap technology one, though, is one where some folks like to see some of the activity play out in the equity side with regard to inflation and rates. If you take a look at Alphabet and Microsoft, these two stocks, because of the earnings drivers that we have, had seen a little bit of volatility in the trade, but have now settled back into kind of where they were before. Alphabet up 11%, Microsoft up about 4%. And then, of course, Meta Platforms is up 0.25% after losing 10.5% in yesterday's session on the heels of its earnings report. So those so-called mega cap tech trades still playing out as well. And then, of course, on the energy side of things, just a quick check on ExxonMobil and Chevron as well. Both those shares still down. Chevron down 0.5%. ExxonMobil down 1.5% on the heels of mixed earnings reports there for both of those companies, impacted by lower nat gas prices as well as refining margins that came in a little bit lower than what some people had hoped for. WTI crude prices up 0.25%, or now 0.75%, $84.25, and an energy ETF down 0.5% as well. Andrew, that's the state of play. I'll send things back over to you.
Thank you very much, Dom. Have a great weekend.
You too.
Up next, Bank of America's Savita Subramanian will join us on set to talk about a big week for the markets and today's new inflation data. And a reminder for you, on May 4th, Warren Buffett's going to be holding court in Omaha, answering shareholder questions for 5 hours at the Berkshire Hathaway annual meeting. If you're a shareholder and have a question, please send it to berkshirequestions@cnbc.com. We'll go through them and select some to read during the meeting. Stay tuned. We'll be right back.
Will.com.
This is the futures following the new PCE inflation data, and you can see that we are seeing some gains. That briefly going better than that just a little while ago on the Dow and the NASDAQ. It's pulled back from there. Here to talk markets, Savita Subramanian, head of U.S. equity and quantitative strategy at B of A Securities. And I would say for a couple of months, actually longer, you've been feeling pretty good about things.
I have,
And
yeah.
still, and even after all this recent stuff, I think the way you phrase it, the bell curve between stagflation and recession, there's a lot of room for things
so
not
much
that,
room in between. Yes.
that could be good.
Yes, exactly. And I think that, what we've been pointing out is that in conversations with clients, I feel like there's been this swing from the world is ending, we're going into a recession, to inflation is out of control, it's stagflation. But there's, 98 or 96% of that bell curve is, all the rest of the scenarios that are more likely to happen. And I think that what investors may not be appreciating is that the economy is actually doing okay. Maybe it's slowing a little bit from last year because of things like fiscal impulse and, other factors, but consumption is still healthy. People are still gainfully employed. The layoff cycle seems like it's not necessarily amplifying. I mean, so far during this earnings season, we've heard some layoffs, but nothing to write home about. So I still feel like we're in a spot that's, kind of a glass half full view.
About a month ago, I think, it's crazy, I've got it in the notes here, that they found a big argument between two Bank of America strategists. So you got Michael Hartnett, your guy who's head of investment, and you, who's head of the quantitative strategy.
US
Yeah,
equities,
okay.
yeah.
So
Yep.
you were saying things really are not that euphoric yet. He was thinking he was saying you're starting to see some euphoria manifested in the Magnificent Seven.
Right.
So he may have been on to something in terms of this recent
I agree.
pullback.
Yeah,
But you're still say there's still now there's even less euphoria than when that article.
Exactly. I mean, the Magnificent Seven was crowded. That was not our favorite place to be. We were underweight information technology heading into this year. For a couple of months, that was not the right call, but it's starting to play through. But I think the idea is there's more in the market besides AI CapEx takers. There's more to the S&P 500 than just semiconductors and software companies and, Meta and these, mega cap tech companies. And I think what's happening now is we're seeing the market broaden out, and other companies are starting to beat earnings expectations and rally, but the Magnificent Seven is kind of dragging everything down. Maybe that continues a little bit longer, but I do think that we're in an environment where the health of the consumer and the corporate is still not imperiled by anything we're seeing in the macro data.
I mean, it hasn't been much of a pullback, but then yesterday it looked like it might
Really?
Turn into something worse.
Yeah.
Maybe 10% instead of just 5%.
Sure, and 10% corrections are kind of normal. I mean, they happen once a year on average. 5% pullbacks happen 3 times a year on average. So, it kind of felt like we were due for a pullback. But I think what's going on right now is we're still in that wall of worry type of environment. And I think there is euphoria in certain themes like the Magnificent Seven, like, GLP-1, other areas of the market. Maybe it's moving into power now, the idea that we need all this power to fire up the chips and, get this AI thing going. But I think that at some level, when you look at positioning of any kind of asset owner, if you look at pension funds in the US, they have the lowest allocation to public equities that we've seen since at least the 90s. And the reason is everyone's gone into private, illiquid, real estate, private equity, private credit. Public equities are like the forgotten land, except for these few companies that have led the S&P 500. Nobody loves small caps. There's a huge array of US equity opportunities that are really flying under the radar today, and that's what I like.
If you did have to pick a poison, would it be that growth is slowing or that inflation is sticky?
I think that if growth is slowing, we're going to be wrong on the view that you don't want to be in these mega cap tech companies. But I think if inflation is sticky, you really want to be in equities, definitely more than you want to be in fixed income, because equities, they earn and their earnings are nominal, whereas fixed income is literally, by definition, fixed income. And for retirees, which hold the bulk of assets out there, you know, what do you need in an environment where inflation is sticky and yields are still kind of low? I mean, 5% isn't crazy high. We've seen higher yields in prior cycles. You want to own inflation-protected income, which I think is the reason to own the S&P 500.
I mean, we really did go from, I guess you can't be in Goldilocks land that long, but we were 3.5 GDP, inflation trending in the right way. The Fed can cut 3, 4, 5 times. The economy's strong, but inflation's low. We're going to be able to cut, and then that was all. That all kind of, it went up in smoke.
We had 1 quarter of like a slowdown in GDP. We've still got hot services demand. We've got consumers still spending. We've got balance sheets still okay. Delinquencies are rising. Things are normalizing, but we're not going off a cliff. But I think that's the view that the average investor has.
And you think, were you surprised Leisman said that we could get a couple of cuts still?
Yeah, I mean, I think he's talking about the Fed's framework for it still leaves an opening.
You
but
think?
I think there's a very high probability the Fed does nothing this year, or maybe even we get another hike.
That's
and I think that would
but
be okay.
But it's okay if the economy's strong.
Exactly.
Well, it's necessary if the economy's strong.
If the economy is strong, it could be because something else falls apart or breaks.
Right.
Like that's.
I don't know why we're hoping for rate cuts, because it means something is breaking.
I still think David Diamond might be right about that. That would be the scariest thing.
Inflation argument.
Is that it's not under control and they need to keep going further even though the economy is already slowing.
Well, if we are in that stagflationary setup, what do you want to own? You want to own equity income, high dividend yield, utilities, energy. You want to own equities. You don't want to own bonds in a stagflationary environment. And I think that's the critical message. There's still a huge glut of assets.
But what do you do with all the risk-on stuff? I mean, the NVIDIAs and the Magnificent Seven stuff and everything else in that environment.
I think we're in a stagflationary setup. You look for the folks that are generating the highest free cash flow. And that is, right now, it's energy, financials, some tech, but not all tech. You look for companies that aren't spending on CapEx. I think what's different in the Magnificent Seven today versus last year is that these companies are actually spending on CapEx. And they're not firing people anymore. Last year, they were firing people and cutting CapEx. They were shoring up capital, and they outperformed. Their earnings were the best game in town. This year, they're spending, and they're not necessarily cutting costs. And I think that's the difference, is you're seeing other areas of the economy actually accelerate, whereas mega cap tech is decelerating.
Right, Savita, thanks.
Thank you.
Happy Friday. Final check on the markets. And the futures had spiked right at 8:30, but now we see the Dow still up 51 points. Rough session yesterday. Got the NASDAQ, with some of those strong tech earnings sharply higher. I'll see you.
Right.
We're going to be hanging out.
See you on Monday, everybody.
I'll see you on Monday.
Yeah.
Well, not see you guys this week.
Make sure you join us. We hang out most weekend. Make sure you join us next week. Squawk on the Street is next.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Keaton here with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Futures are feeling some relief, not just from Microsoft, Google earnings and guidance, but this morning core PCE mostly in line, lowest year-on-year number since 2021. Bond yields are lower across the curve. Our roadmap's going to begin with big tech, though, bouncing back. Alphabet and Microsoft both up sharply on their respective beats.
Plus, the Biden administration is awarding Micron $6 billion in federal grants. This to boost production of chips in the state of New York and Idaho. We're going to discuss all of that with Micron CEO. He's live here at Post 9. And the oil giants, Exxon and Chevron, both posting lower first quarter profits. Chevron CEO Mike Wirth is going to join us. That'll be later this hour. We, of course, will go over those results.
Let's begin with the markets and this morning's inflation data. Highly anticipated, Jim. Not just core PCE, but best couple of months on spending in about a year.
Look, this is a front seat, back seat day versus the what we got. I wouldn't even think. I'm going to go as far as Dave. I'm going to mention somebody. You tell me if you agree. Pangloss. Panglossian number.
Panglossian number. That's where you're
What, are we
starting
taking
the show.
the SAT this
That's
morning?
where
What
you're
is this?
starting the show today.
What did?
On this Friday in late April.
Pangloss, man.
Okay.
Get me Pangloss.
You want to explain that to
Okay,
everybody else?
because we have the bonds are right. I have to tell you, Carl, last night, I'm like sending a note to Ruth Porat in the middle of the night. She's like, you know, fantastic. I mean, what did she's Alphabet did?
Yes, she's the
Alphabet
president.
gave us not only an unbelievable blowout number, but they also gave us granularity. They told us what's going on. It was joy. It was I left that Time Warner dinner with Sarah. Hey, you like that, dropping that. And it was just incredible. That was one of the greatest conference calls. And then Microsoft blows Alphabet away with how great it was.
Does Microsoft blow Alphabet away? Really?
Kind of.
You think so?
I just think the increase there is just extraordinary.
The increase?
Well, because the use of AI.
The increase being what?
Just the
overall
amount of
increase in the use of what?
Azure, the upside surprise. The upside surprise was remarkable. Because it was both top and bottom line. And Amy Hood, who is like never effusive, I thought came in and kind of just said, all right, this is ours. Give me the ball. And I thought it was a great quarter. What can I say? And then, by the way, Snap. I mean, I know we're small, but I think you have my man from Snap.
We do have Evan, yes, that's
Well,
right. This
that'll be
morning.
good. Look, you did. I mean, I know it's not big, but we had a night last night about AI, David, that tells me it's real.
Well, the spending is incredible.
It's
While
incredible.
you were at your fancy dinner, I was just home watching the Knicks lose, but reading those conference calls. And the thing that stands out, of course, in both Microsoft
Was
and
how badly the
Alphabet,
Sixers played in the first half?
No,
Oh.
it was how much they're spending, how much they continue to spend. This after, of course, Meta took up guidance on its capex to what could be as high as $40 billion. Though
I
most
know.
people don't expect it will necessarily go there during the course
Yeah,
of
we
the
have
year.
Sanjay Mehrotra
But we're
from
talking
Micron.
now $50 billion from Microsoft potentially. Somebody on the call asking, could you see yourself spending $100 billion? And they didn't really say no.
When that's a check to who?
It's all NVIDIA.
Right, and who was on 60 Minutes on Sunday night?
I don't know because it's Friday.
Jensen. Jensen's going to be on.
Oh.
Da Vinci himself.
Ramondo last weekend and Jensen this weekend.
Become more of a business show.
Yeah.
Too bad there aren't anybody who can do a good business interview. But
That's Bill Whitaker's going to be fabulous. This is
Oh, it's Bill
terrific
Whitaker?
interview.
Oh,
It's going to be a terrific interview. But I just think that this, Carl, what this said was, I understand exactly why Zuckerberg has to spend the money, because this is an arms race. Who has the best AI? Who has the best interaction with when you speak to AI? And right now, Alphabet surprised me.
You seem a lot more interested in this than Core PCE.
Core PCE.
Yeah.
We tried to lead with the Core PCE.
No, Core
And you
PCE.
came up with a
just
word,
restacked
pan
the
gloss,
show.
that nobody really knows what the heck you're talking about, and then you moved on.
Forget the pan gloss, okay? I mean, it was like, forget it. It wiped it out in the sense that we no longer have to be as concerned. I will go so far as to say that, let's say President Trump were elected, I think he'd say, you know what, Fed, knock yourself out. As opposed to the New York Times story, or the Wall Street Journal story, which basically said that no interest rate moves will be made without him. This number was good enough to make it so that Powell is now able to say, if things don't go our way, we can cut it. We can. Because it was not stagflation. That was an amazing story. It's not stagflation. That's what happened. We took stagflation off the table there.
Oh, so it lasted for less than 24 hours.
Because we got rid of the stag or the flation? The stag.
More the stag
Yeah.
than the
More the
inflation.
stag. Got it.
Yeah.
Okay, well, thank you for that analysis.
Why do you hurt me, Michael? Can we just go over for a second what happened here?
Sure, what happened?
Okay, so we did have, this is what happened. This is why I'm going to drop the pan gloss, all right?
Okay, thank you.
Talk a little more Voltaire. We'll
Okay,
go Voltaire.
perfect. Yeah,
no, we're
great.
going to do rap.
Are you going to do it in the original French?
No, actually, we're going to do about much. We're going to do Erasmus. We're going to do much ado about nothing.
Ah.
That's what that was.
Okay.
That's actually Shakespeare mixed with.
Yes, I'm aware.
All right. So here's what's going on. March was a weak month, and that's why I'm not worried. March was a weak month, and we're getting that from a lot of different companies. that say, like a JB Hunt. March was a week. All the transport, except for Union Pacific, because they have precision railroading. Do you see that number? By Jim Venna?
Yeah.
Your partner? Your pal?
We do have a downgraded night today. Jim, we got a downgraded cat on the notion that the business is operating well, but looks to flatten in the near term.
Well, because March was weaker. And it's hard to get a grip on why March was weaker because you have so much infrastructure money coming in. So I was surprised, but I know that there wasn't a...
By the way, they increased their target to 350.
Well, I mean, you got some of these guys with bears at 208 that are really terrible. But I just think that what's happened, Carlos, is that it's the JB Hunt, which is that you had a good January, you had a spike in February, and then you had a decline in freight. It was one of the most amazing conference calls ever in terms of like a realization that March just got weak. And what people say it was the 60 basis point increase really, really hurt everybody other than housing, because housing was offered the equivalent of a variable rate deal.
So the move up in interest rates during
Really
that course,
hurt.
yeah.
Really?
No, there was.
Really
No,
hurt.
you're right. I've heard this. We talked about this now for a couple of weeks because we've both been getting similar data points from people.
Well,
I think in terms of deceleration through March.
And
okay, the question is, has it continued?
Yes. April's just okay. Just okay. Now, look, we'll hear. I thought that when you retweeted Doug McMillan,
The U.S. chief, actually, John Ferner, talked to ABC News.
From Walmart. Now McMillan did say, both Costco and McMillan said, and that was Rich Galanti, who's retired, who's like the best CFO.
Rich Galanti was the CFO of Costco.
Right.
McMillan
And they
was the
both-
CEO of Walmart. We're talking about Walmart and Costco.
Well, they both said, listen, we're going to hold the line on inflation. Now, that's 200 million people that we're talking about that benefit. Doug said there's someone Mad Money he said, listen, I think we can hold the line. So if you can check inflation, particularly at the food level, which would be Costco and Walmart, you're really left with, and you don't have to worry about auto because we know, I met with Carvana last week and finally the used cars are coming down. We know that from CarMax. That leaves shelter. And shelter's hard to get around because of the 10 million new people have come to the country. It's also because it's just the building didn't occur that we thought. It just didn't occur. But if just shelter, then the American people are going to get lower rates at some point this year.
In the back half of the year, you think?
Yeah, because shelter's doable. It's doable. I mean, you can't put things up right now, but a lot of places started right after COVID, and they're going to come online in the next 6 months. That could help shelter. Even though, David, no one's building more houses than they want because they all build to spec. No one builds just like, hey, you know what, we'll put up a lot of houses and see what happens. They don't do that anymore. That's why Toll had a good numbers, why Pulte had a good numbers, why KBH had a good numbers, why Lennar had a good number.
Right. That has been one of the features of this last couple of years, and unexpectedly, it's been the strength of the home builders.
They have discipline.
Even with, of course, a significantly enormous, 550 basis point rise in rates.
Look, we're building half as many homes as we did when we were a country of 150 million people.
We're underbuilt.
We're underbuilt.
We're underhoused. Oh, yeah.
Good morning, beautiful
Friday
people.
here. You guys look great in those nice ties. Beautiful.
Time is 8:10.
Wow.
You should wear a t-shirt that protects your shirt. A t-shirt? Yeah.
Oh, yeah?
Protects your shirt.
I don't-
Yeah, keeps it from filthy.
T-shirt guy.
I learned that at Goldman. They sent me home the first day. They said, where's your t-shirt? I said, yeah, wait a minute. You don't work here without a t-shirt.
I'm learning too much about you
I go to
guys.
Century 21. Then they said, did you go to Century 21?
When we come back, as Jim and David mentioned, Micron's chief Sanjay Mehrotra on the billions his company is set to receive in this CHIPS Act funding. He'll join us here at Post 9. Meantime, pre-market looking pretty good, although Dow remains on pace for the worst month since September of 22. Don't go away.
Okay. Well, I'm waiting for the pullback. We'll see if it happens. I'm going to turn on the air and make a cup of coffee and cook an egg sandwich. I've been up all night. Been waiting for it to rain all night. It's been one of them real dark nights where you know it's going to rain, and then the sun comes out and there's no sun. I mean, it's dark. Probably hear thunder today. I live in Missouri, and we're called Tornado Alley. We have more tornadoes, Oklahoma, Kansas, but we have a lot of them in Missouri. If you remember the Joplin tornado, F5 that happened, it grabbed a baby out of a woman's arm. Bye-bye, baby. The whole town was just flattened. I think I had 165 deaths in a matter of 3 minutes. If you've ever been in a tornado, it's a lot worse than a hurricane. Hurricane, you can be prepared. Tornado can just drop out of the sky. You get a little warning sometimes, but you never know. Remember one year where we had 183 tornadoes in one season. So we're flat NASDAQ. I was reading this guy.
$6.1 billion
Oh,
in
God.
such funding paired with $125 billion from Micron to build these.
You sucker, quit spending that goddamn money.
Headquarters in Idaho. You know,
Let them spend it.
it's been mentioned before.
See, that's called socialism. When the government, what do you call it? When the government, I can't even think one. I'm going to do some plagiarism. Political is economic theory that social organization and advocates that the means of production, that they want to control the production of the economy, where capitalism is where the private sector controls the economy. And every time the government gets involved in something like this, it never works out. We bailed out General Motors 3 different times, so that's a pretty good example. And we bailed them out again with the EV car sector. So, won't be listening to them today. They'll get me going. I really enjoyed Schwab yesterday. They kind of changed it around a little bit. I didn't get to see my brother Johnny. So I'm going to go over the watch list. First I'm going to turn on the air, turn on the water. Ouch. Good morning, YouTubies. Say hello. I'm going to be watching you today. Looks like I already got a like first thing in the morning. Hey, your dad was a wonderful man. I can't remember. I remember that time where he took me to that gay bar. Oh, he's gone now. I said, what is this? Don't tell my son, he says. Okay. So we're going to go over the watch list. I have no swings. Volume high, the SPY. I'm going to see if it breaks support. And then if it does, we can start seeing it drop. Now, I don't... There's a big jump there into hours after hours. I don't know what caused that. But if that takes us to the, let me see. Yeah, we're not there. That's the 9. Go back to the 1. When this? Oh yeah. We're above that moving average. We're above the 9. So this could hold. What do I say? 556, 506.49 is the 9 EMA on weekly time frame. Damn, I didn't even have it on the... Okay, Jimmy. Is that why you got an F in typing? 506. Type in SPY. They wanted to break that 9. That's what they wanted to do, I think. What the heck? SPY. Woo! SPY. 506. I gotta get in sync here. 49 is the 9 EMA on weekly. What is different from Schwab? CNBC talks politics all day long, and Schwab takes out politics and talks about stocks and charts and trades. And I mean, if they talk about a stock, they're going to pull up a chart. CNBC won't do that. You just got them loudmouths on there pumping their stocks. Here, they're kind of more genuine. I get really, I get shook up here on CNBC, so I'm just going to avoid listening to them. Unless it comes between that one period, what do you say, 11 and 12, I might turn them on. Turn them on in the morning first thing, and then that. There's just too much politics. I don't really care about it. It doesn't. Magnificent made a very good point, and I thought about it over the weekend. That it throws me off my game. I mean, I can really get into it. I was in student government and all that stuff in college, but I think it takes away from what I'm trying to get to. I like listening to them because I can debate them, and it helps me with trade too, but I don't think it helps the room to listen to me rant and rave all day long about disagreeing with them. And then maybe I'm wrong. And then, so I'm sitting here making a fool. And it could come back and haunt me. Maybe. What was I thinking here? Chart. Oh yeah. And I'm the only one that can be rude. But I do it in a fun way. We got a good team in here, that's for sure. Small but good. And I respect everybody in here. So, that's the baby today. If she holds 50649, we're still bullish. And I'm going to go over the watch list. Hello, Michelle. Loom, Johnny X, Randy. Are you up, Randy? Did your 420? Every time I see that word Johnny, it reminds me of Johnny Cash. I fell into the burning ring of fire. I went down, 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 them flames went higher, and I burned, 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 that ring of fire, that ring of fire. Love has a sweet taste. I can't remember how it goes now. I used to sing that every day. That was one of my most requested songs. Oh yeah, I was going to go over the watch list. And my water. I'll be right back. Might even not do it. So we got some that took a hit. Microsoft, Google, quadrupled their cloud. So I think that's going to start kicking butt. Then we're going to have to keep an eye on Amazon too. He's been the silent creature. Oh, dadgummit, I knew it. There it is. Somebody bought into the market yesterday, so we need to pull back some, maybe. I'm not going to be rushing nothing today. We got IBM. Microsoft needs to pull back some probably. Yeah. Microsoft had too big. This is how you want you to do Microsoft. Take and put a Fibby on it to the top, to the bottom of the breakout, and see if it pulls back. There you go. Right to the 50%. So maybe right at open you can get a trade on this. Double bottom. Or it pulls back to the 38 at 408. So you're definitely at a 50% support right now. MSFT. I'll get you resistance. Microsoft, the pullback, we got a 50% pullback on the fibs. I'm not sure yet. Got to wait and see how it breaks out. And watch how I put these in here, and I'll put the chart in. It might be a lesson for you if you're new to Fibbies. Oh shit. Already here, Tesla. And it happened fast. Okay, resistance is a triple top, quad top. Oh, here we go. Let's go to 190. Okay, I got it. I got it. Now they're picking on him again this morning. So we broke resistance. And we got a head and shoulders right here. So this is the new resistance to break, is 177 something. Right there. Let's see. Now you see I didn't take that one right there? I took this one right here. I want to try to make sure that we hit that. So 177.16 and support to hold has to be right around 163.49 for Tesla. 163.49. There you go. If it hits that 163.49 50 area, give it a few minutes and see if it goes sideways, and then look at the candles that follow that support. For dojis or hammers or something that's a reversal candle. I didn't set my support alert here on SPY, so we're going to have 3 black crows maybe. Got a big volume spike right at open. So this is going to be the first goalpost. Now if we get another big volume spike, that's when we want to start really looking at the trade. For example, we had a big volume spike right here, and then at the end of the day, SPX had a big old pop up to the upside. Ready, set, go. It's ready, set, go on the 5 minute. On the 1 minute also. Oh, that's very positive in volume. We got a big volume. No, not a volume, but a TTM squeeze. So if we break 50.84, we can start being bullish. Three black crows. That was the scalp. Randy, double top, buddy. It's, oh gosh, I don't have my platform up. Only got one of them up. What the heck? Key Fed inflation measure rose 2 in March from a year ago, more than expected. That's not good, is it? I heard today, well, let's talk about that later. I think, well, we'll talk about it later. About the Fed. The rumor going around today. I'm trying to get this platform up so I can buy a put maybe. SPY. SPX. What happened to it? I'll go see that trade. They're so fucking high. These puts are high. implied volatility. Huh. Huge gap up, but then we had a huge gap down. We're at resistance. I should have took that trade. 3 black crows. Okay, we're breaking it. I just think it's way too high, but see if I can get a straddle. Ooh. I ain't paying that. We pulled back to that 38 on Microsoft. We pulled back to the 38 on Microsoft. Today's losers: Boeing, Humana, A-Lab, and Uber. Lilly and CCL. Today's winners: BYDDF, Snow is up. Nice little support right there. Now watch her come down. I took my eye off of it. That's stupid.
$2 billion, but really the concern is about the outlook for Intel for its second quarter. It's projecting revenue between
a few months ago, man, we were all excited about Intel. You know, had a great run, had great news, and then the war came, and Israel, or even later, I don't know. It was during the war, I think. Now, nothing but bad news.
Far ahead of them. Now, NVIDIA, AMD, I mean, there's basically no question, obviously. But when you look at kind of that second tier of chips, there are plenty of companies that are supposedly positioned to AI that are still showing trailing flat revenues or even down. And Intel's actually up. So it's like, you know, the market's so myopic on are you leading this AI movement? And they're not. But
a winner.
Yeah, but they're still like a pretty good kind of bastion of general hardware sales that reflect a decent cycle when, you know, revenues are up 9%. Like, they get no credit for that. It's pretty harsh. I mean,
oh, man.
A year ago lost money, and this quarter they reported 18 cents. I mean, it seems like they're kind of executing this catch-up like the market wanted.
Well, let me tell you, about some of the analysts' commentary. So, Mizuho analysts saying that the outlook is, quote, much worse than expected, suggesting a bottom has not been made yet. So, the idea is that would cast a cloud over any kind of potential bullish sentiment from the top brass at Intel. And you're seeing that play out today in the market action. So, again, we've talked about this before, the market looking for winners here. Who are the winners? Who are the leaders? Who are the laggards? They're not going to chase the laggards, even if the space has the opportunity for there to be a second and third place. Right now, they're saying Intel is not second or third. Definitely not second.
For sure. Yeah, no, 100%. I guess, too, the other thing is that everything they are doing to catch up is pretty expensive, too. So if the market punished Meta for a lift-off in CapEx, when Meta's doing almost 30% top-line growth, then they're clearly going to punish Intel, where the expenses also rose quite significantly, while they are only growing 9%. So, I mean, their R&D expenses $4.4 billion almost. Street was looking for like 3.9. So, I mean, yeah, it's a costly catch-up that they're playing. So that part I can get. But all right, I mean, look, at least it still has some growth in it. How about Roku, Diane? As the kind of fun one, the kind of wild child of streaming.
It is. It's a fun one to chat about. If you look at the shares, though, it's not a fun one to be in today. That stock down 9% after its quarterly report card. Roku saying revenue came in at $881.5 million. Reported a net loss of 35 cents a share. Revenue was actually better than expected. Here's the challenges for Roku. It's just really this difficult streaming landscape. Roku warning that this push by the streaming competitors towards these ad-based offerings, it could hurt its growth this year. And so even though its results were actually better than expected, flagging the competition causes some concerns, right? Company top brass says Roku faces, quote, difficult year-over-year growth rate comparisons within streaming service distribution activities. The headwind is due to past price increases and a higher shift toward ad-supported offerings. So again, calling out those ad-supported offerings, the competition there, and also the problem with price increases. Can it maintain pricing power in this competitive landscape when it's going after all these, when the streaming landscape is so just full, really? There are so many competitors within that space, and people are they're cutting back on prices and cutting back on what they have in their bundles. So Roku facing some challenges there. Stock again down 9% right now. Let's take a look at where it is. Year to date is down 35%. So it's really taking a heavy hit.
Just seems like the stock is stuck. It's kind of in this quicksand of kind of post-COVID drag still, where it's just so hard after doing 50% revenue growth years back to back. It's just the adoption window closed a while ago, and now they've got just immense amounts of competition, software and hardware at this point. All right, thanks, Diane. Thanks very much.
You got it.
Good stuff taking us through the earnings. Hey, little secret winner of the morning, by the way, is Colgate-Palmolive. The staple is actually the one making one-year highs this morning out of all the stocks. When we come back, we're going to keep our eyes on earnings some more and take a look at Exxon, Chevron.
Exxon
trading in the energy
had some
looking back up here.
summary news. Earnings were kind of not as good as they were expecting. heard that this morning. Just Berlingo is selling 1.8 million worth of what? Ooh, that's nasty. RITM looking for highs, I think, as well. Randy's going to have a parade. RITM. Oh. Do we know, do you remember my resistance on that one, Randis? Do you remember? 1152. To break. Good. 1 2 bits. Snake, breakout, pull back, boom. Snake, breakout, pull back, boom. Snake, breakout, pull back, boom. I wish I still had mine at $9. 1152. Netflix pulling back, got a head and shoulders. Netflix, we got to break 55695. Netflix. Now AMD had a pop after hours yesterday and pulled back. SPY broke the 200. Okay, 50823 for the SPY. We held that 49. This is a big deal. This is a big deal. So far, it's a big deal. Meta. Now, what did I just have that on? What time frame did I have that on? Okay, that's the 1 minute. Meta needs to break the 200 SMA. Meta needs to break the 200 SMA. 508.30 is a big number for Yoko on the SPY. Whoops. Damn it. SMCI, I think we got the 200 SMA in a range. AMD at the 200. Meta. Okay. SPY. Now what was, let's see what the weekly is on this one here. Weekly, I don't have the 200 on. What? SPX. I don't have the 21 on here. That don't make sense. Oh. Yeah, we broke the 9. I'm going to say that 508,467 is the number we need to hold. 50. Okay. SMCIO. Damn it. I didn't want to win. I heard, oh, let me see what someone else wrote something in here. I heard that China's getting real friendly to a country about 250 miles from us. They're going to build an airport, trade currency, make it a Bitcoin thingamajigger. A little closer to our country, a little too close. So the Biden administration better watch how they talk. Agree, you guys will mostly be trading without me today. Remember a couple of days ago when we were talking about just not feeling right, ready to trade? That's kind of where I am today. Well, that's good. That's what Yoko had just stated was probably very honest. When you're, I mean, everybody's the same way. When there's days where you come in and you just don't want to trade, or you're grumpy, or you're getting ragged on, or just your stomach's not feeling good, or your head. The other day I come in here and I couldn't hardly think. I think it was because I wasn't high, but if you're not in the mood, it's better just to kick back and take back and walk away. You know your body, you know your mind and your awareness and your senses. And I respect that, Yoko. Okay, we got a 1, 2, 3 on the SPX. We're going to find out here shortly. SPX, baby. There we go. New high. Old MacDonald had a farm. Me-I-yo. With a quack quack. The 29th on the calls. For the SPY. Now the 5110s went from 272 to right now at 840. So the 9 now becomes our support on the 1 minute. Implied volatility, gamma at 1, open interest. So I don't like that. I like that. No, I don't. That's a good call on the 1, 2, 3. What am I doing? Now, let's see if we get a pullback here. We can go higher. I got 2 trend lines. Okay, that's 2 trend lines right there. Let me get out of this. $890. $910. Come on. Oh yeah. Get ready. $970. SPX. Have your fingers on the mouse. I'm 860. What are you talking about? 840. That's an easy $120, and I still got 1 left. If you can count to 3, you can trade with me. Now this had a tweezer bottom on the 3rd one, so you got a tweezer bottom. No, that's tweezer. You tweezered? Trying to get that number. 5108.62. What did I say again? 11. Fuck. 51. 5108. We're pulling back. We're on the 9 now on SPX. $520s on the chart of RITM. Yes, you always, well, how's it? Your gut will tell you that. But let's look at something. I'm going to lower it to 1140. It's got to break 1140. Has to break 1140. Randy? You see the body of that candle there on the weekly? 3-year time frame. Then you got the wicks, but I'd stick with that body right there at 1140. And if you break that, I think you can move up higher.
GDP number come in a little bit light compared to the last couple months. You know, we had some really good quarters there that just surprised. And then our inflation numbers all seem pretty sticky. Today, inflation expectations and the sentiment number are there, and obviously our PCE is still warm. Bonds are kind of taking that in stride, though. What do you think is that balancing act we're striking right now from the data this week?
So for me, I take a little bit from the flash PM.
I truly believe that Powell needs to be fired. Now, this is what I heard today, and I agree in a way, but then I can see. I think the Fed has got too much into politics is number one. So there was mention in this morning, CNBC couldn't be quiet about Trump saying that he was going to regulate the Feds to where he has a little say, the president has a little say in what's going on with his economy. And I think that's a good idea, personally, because you're running an economy, then you got somebody on the outside that's trying to play games with something that they tested 40, 50, 60 years ago, back in 1970 and 80, and they're comparing them days to now, and it's not the brightest thing to do. We're in a whole different economy now. It's like apples to oranges. You can't compare and do the same thing that they were doing back then. So Trump wants to have a little bit more say with the Fed. I think it's a great idea. If I was president, I would it's like talking to your own accountant, you know, in your own business. It's the same thing that the Fed does. So I see no problem. The government needs to be run like a business instead of some kind of Marxist gangster kind of thing. I'm waiting for this support. I'm going to raise it up just a little bit. But I can see the principle to the other side say, well, that's kind of partisan, ain't it? That is, in a way. I mean, you got the guy you want in there. Because I think Powell's doing a horrible job. Horrible. ETFs on Bitcoin are down today, Mike, if you're listening.
Break down in a big way, or should we be actively trying to like hedge out tech concentration?
I think you should be actively trying, but I don't think you should be making decisions, just based on that.
Apple new high.
We're always looking for rising estimate, revisions.
You like it?
And
I like it too.
If you can find that in some other areas, that's great. It should definitely be there. There's like some restaurant companies that wink at me every once in a while. I saw Chipotle have a great quarter. I think Cabo's a good sort of derivative there.
Always clean as Jim.
Stuff like that. That's kind of you have to have it in portfolios because if you're just super concentrated.
Hello. Hello.
Good morning. My name is Catherine. The reason for my call
Yeah.
is that the updated plan for Medicare has just been released.
Is this a robot?
Do you have a minute to check what additional benefits you can qualify for?
No.
What we do here is help you get additional benefits like dental, vision, hearing, prescription coverages, and food cards, and absolutely. In order to do that, we need to confirm ability. Do you have Part A and Part B of Medicare?
No.
Okay. Unfortunately, you do not qualify for the benefits we have. I'm sorry.
You wasted my time. I don't even know what. Do they have counselors for people when you get old? I have no idea what's going to happen to me next 5-10 years. Medicare, Medicaid, blah, blah, blah. Yesterday I got a call about coffin in my burial plot. I'm really looking forward to death. God, I'm sorry. I didn't mean to do it. Yes, I put the inkwell in Sally's hair at 9th grade. It was me.
Out on May 15th, and then that's really going to be, I think, an important print. As I say, I think the bond market really takes their cues from the official data, take it from Fed messaging, but there's a little hint and a glimmer, and I put a little extra emphasis on the PMI data because it's forward-looking. It's one of our most consistent leading economic indicators, and it's pointing to disinflation beginning in April. I'm not maybe not beginning in April,
Meta
but definitely
dropping
in April,
down.
and hopefully it's the start of a little bit of a trend.
All right, so I hope that maybe
425
we can get back to that.
Meta.
This was just sort of an outburst, an offshoot from the general disinflationary trend. I mean, that would be a very helpful print next month when we get it, because right now, I think
We broke support.
say 3 makes a trend. We got 3 months of high inflation, but because people really want those cuts, they don't want inflation. They're saying, all right, maybe it's 4 that make a trend instead, which means
It makes no sense what he's
we've
doing.
extended our tolerance.
Your point, like going back to it, like we're talking about overnight earnings, we're talking about like Microsoft and Google. I mean, there's some.
If we do get the
really exciting
interest
things
rate
going
cuts,
on.
I think we're going to have a heck of a
Say,
boom.
okay, especially from a consumer standpoint, what's the
3 black crows on Apple.
application for AI? And I struggle to find what I'm going to do. You're going to complete my sentences in Outlook. Big deal. That's been.
We got AMD at the 50, and we got Amazon at the 200 on the 1 minute, 5 minute. These are 5 minute. Let's do that. Let's play the 5 minute here. I can do that. I can play anything except a piano. Maybe 1 or 2 songs on that. So the 5 minute hit that. RITM Randy's on the VWAP. RITM on the VWAP. Pulled back to the daily, double bottom on the VWAP. Ah, shit. ABVC I'm watching here. Let's go. I'll join you at 500. Apple looks good to the 204 hour for me. Taking Jim's apple. Oh. Be careful. Crude oil report. Atlanta Fed GDP now at 12:30. Throw in Intel as well as a loser. Oh boy. We got a 1, 2, 3. On IWM. Netflix trying to break 5.6595. Apple 174.97 long. 174.97 long on Apple maybe. Apple would be the listed long. Oh, that's pretty high. What'd I say? Oh, 174. I fine-tune it, it'd be 174. Here, I got to put this on a different time frame. 171.75 is a resistance to break. So we're broke below support now on SPX.
When you're looking for a pre-owned vehicle with a no-pressure buying experience.
Watch SMCI here off the 63. We got a flag. Well, actually, it might be a Head and Shoulders, which would be, well, I don't know. I'm just not feeling very anxious to jump in the trades right now. We're getting ready to squeeze, Yoko. Mr. Big B. Big C. Make some more coffee. They're about ready to leave. 8 more minutes. Spy broke the flag. Come on, what are you going to do? Spy here any second. We're at a triple top, which is bearish. Bingo. Nailed it. Another boom boom, baby. Hey, Magnificent, can we bring back some old memories? Like an A+. I want an A+. Oh, what am I doing? I'm going through my social media. Shit. How long has it been up there? I don't even know. Let me see if Patrick put me on his list. I made it. I made the list. There it is. No. Damn, he didn't put me on it. This is a friend of mine. He did a thing in Rwanda during the Clinton years, during the genocide. If y'all remember that. Clinton stole a bunch of money from the foundation. And then they called it the whatever foundation. I played music with this guy a lot.
It's definitely, I think, on the table. It's just not open enough to talk about it just yet. Even some have hinted at, like, if inflation goes the wrong direction, then we may have to take action. That language will stay in place.
There it is.
For Marcus, it means like this is a possibility.
All the wounds from the past came to the party. Lord have mercy. Such Suddenly the clouds rolled in and the skies were blue. Everything confusing, what shall we do? Take the time to feel within yourself. You have so much in you. Maybe I'll just try this away. Speak of blessings all through the day. Watch them come from far and wide.
They ain't working with training right now. AMD double top. AMD double top. But for what? You're a very funny man. And the video had a nice little breakout. Snake breakout, pullback, boom. Snake breakout, pullback, higher low, boom. Snake on an hour. That's on an hour time frame. Well, well, well. Hey, hey, hey. Well, well, well. Well, well. Hey, hey, hey. NVIDIA's performance against competitors of semiconductors and amps. AMD and Samsung partner. AMD and Samsung partner. There's your hammer. What did I just have it on? We got a gravestone on the video. Gravestone on the video. On the hour. SSNLF. It didn't come up. Huh. $200 SMA, baby. We nailed it. Oops. Norwegian is at 19. Double bottom on Norwegian right now. We could drop more. I'm going to take it to the 18 bucks. I got a triple quad top here off the 200. Norwegian, that's NCLH. Alert set at 1860. At the mark and below. Mark and below. Norwegian. NCLH. CCL. We are at the 63. This is a pivot point with a cup and handle. This could move up. We'll have to just kind of keep this on watch. If not, the 200 for sure, if that does not hold. A 63. CCL. Humana in the red. I was really surprised about this pop we had here. Let it come down. See if this holds right here at 305.88. The Apple's at the 200 right now. Yeah. Brandon says we'll debate. Brandon says that he will debate Trump. Maybe in a few years. Well, it would be a good one, would it? Better be shot up with some good cocaine. I'll be right back. Oh, there's my old family. That's me right there. And that's Johnny. Mommy's holding Johnny. Then we had a bad accident. Dad was an alcoholic and went to prison. So I had to go out and get a job and feed the family. It was a very serious situation at the time. I was only about 12 years old, so I went and got a paper route. Then Mom, she got a job. And little sis had to babysit Johnny and skip school all day. That's my life.
It's time to spotlight the airlines. We've heard from a few of the companies, earnings from Southwest and American this week. Mike Boyd is with us, President, Boyd Group International. Thank you so much for being with us. I do want to go through them a bit.
Wild betting? Oh boy.
Just the big picture of the airlines. Are they in a good place or in a tough spot?
We're in a very tough spot right now. I mean, things have been smokescreen with
What's going up?
Boeing not
What
delivering
stock?
airplanes and Airbus having problems with it.
I want to gamble.
Yeah, I mean, we think about, for example, I mean, let's...
You know why they created AI, Yoko? Because we no longer have any young, intelligent people. They're all morons.
Plans. They have concerns about how the Boeing airplane delays, and those could last well into 2025. So when you think about the stock, you wouldn't touch it. And when you think about the company, if you were the CEO, what would you do differently?
Well, number one, first of all, don't monkey with what works. We're talking now about changing, maybe adding seat fees, things like that. The only reason Southwest has survived is they treated passengers well and passengers simply. I used to have to commute between Denver and Las Vegas, and I almost always took Southwest, not because they were cheaper, because they weren't always cheaper, but I knew I was going to get there. I would not get gouged for fees. That's where Southwest's strength is, and they need to be very careful not to monkey with that. And I think from things that have come out recently, you know, they might have the machine, they might have the wrenches out right now, and I have to be very careful with that.
Right. American Airlines, for example, you know, some people were dissatisfied, but it did swing to a loss, but topped the estimates for the second quarter forecast. What is American Airlines maybe doing right?
Well, the thing is with American Airlines, again, record revenues, and they still lost money. What American's doing right is they are honing down their international traffic. They were smart enough to get another 90 or even up to 140 76-seat jets from Embraer. Those are superb pieces of machinery. Right now, they're in a position where they can take advantage of a lot of opportunities coming up over the next 6-8 months. The question is,
God, they dropped the price on this. Wow.
To watch, and I think that's probably heavy in their planning right now. We're only going to go places where we can make a lot of money.
Yeah, understood. When you talk about the low-cost carriers versus the legacy carriers, I know you had some thoughts on that and the differential. Tell me more about that.
Let's be clear. I mean, ULCCs, Frontier, Spirit, Allegiant, they're in a different air travel category. They're not going after existing demand. They've historically made demand by offering, you know, low leisure fares to leisure destinations. That has been tapped out, and that we have to look at. Keep in mind, Spirit, which is a good airline now, you know, they've had to cut back. Even Frontier is looking at getting into markets where you're fighting with major carriers. That model no longer works. The word U is ultra low cost. They take the ultra out. They have to fight now for traffic, and I think we're going to see a very interesting 6 months ahead because their model is changing dramatically.
When I look at the Jets ETF, for example, 1 year it's up about 15%. It's coming up off the lows that it hit in November. We're showing JetBlue, Spirit, ULCC, Allegiant, some of these names here. I know Delta, another big favorite. People like to watch UAL. Would you buy any of these stocks today or the ETF?
Well, the business I'm in, I don't touch that, but Delta Airlines, you can't find an airline that is better managed than Delta, and we got some good competition like United and American. So what we have here is a situation where we don't have untried squirrels running airlines anymore. When you look at it, I would say Delta, they measure everything. You get on a Delta flight, they probably know your underwear size for your future flying.
God.
That's what we have to do going forward, and Delta really is probably the model for that.
Yeah, and Alaska Air, for example, has hit some recent highs, but all of these are contingent upon
It's none of your business what kind of underwear I'm wearing.
We did hear from at least one airline that some of the business.
The guy says Delta knows what kind of underwear I'm wearing. I'm not wearing any at all.
To have some business travel back, that would be good news. Some of your final thoughts here on the customer, the regular leisure traveler, and the business traveler.
Well, first of all, business travel has dropped off. You know, air travel as a communication system for business travel. You know, a lot of short-haul business travel, a lot of business meetings aren't even necessary anymore. So it's a different genre that's flying. It's still there. Leisure travel, I have some questions about that. It's strong now. But when you have inflation where it is and you have a lot of economic uncertainty, at some point that may crack, right? It hasn't yet. But right now, I think the real future is going to be airlines like American, Delta, United honing up, and Southwest honing up their business level, pandering to the business traveler, because that's where the future business is going to be.
Oh, yeah?
Yeah, I mean, I saw an article that said U.S. Airlines brightens U.S. business travel takes off, and that there is now spending, at least on that part, and it actually quantified what areas. It was technology companies, it was financial companies, I don't remember what else was listed, but you know, we'll see how the economy does in the group, but I think you're right. I think they face an uphill battle. They face delays from Boeing, and so it's not an easy thing to cut a profit, as you wrote. Thank you so much, Mike. Thank you. Mike Boyd, Group International. Coming up next, George Sillis is standing by, and he's taking a look at Western Digital. The company reported its earnings. He will take us through the numbers, some things to watch here when it comes to Western Digital. He'll also have an example trade for us. We'll be right back.
Do 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 do. Do 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 do. Do, do, do. I like that a lot better than that other shit. Much better. Not better than that hard rock and roll.
Cut the cord.
Spies held the VWAP so far in the 200 SMA. You got divergence with the volume to the price. Okay.
Your thoughts on Western Ditch, George?
Yeah, Nicole, I mean, obviously, I think there's a cyclical component to what's going on in the memory markets as well as the flash storage markets for hard disk drives and, of course, server memory and storage. In companies like Dell Computers, Supermicro, these are all companies that are well versed into the server markets. And Western Digital is a player in this space, and we've talked about the transitions I think that are going on in the memory aspects of the computing ecosystem, and the trends have been relatively strong. And if you look at Western Digital's report, it was actually a really good report from the standpoint of beating the earnings. They posted a 63-cent adjusted profit versus a 15-cent estimate. Now, this is a cyclical turnaround because if you look at the same quarter last year, they reported a loss of $1.37. And sales came in ahead of estimates at $3.46 billion versus $3.35, and that was higher by 24% year over year. Now, when you come through the numbers, overall, the cloud computing or cloud storage elements of their business actually grew 45%, and this is their strategy to move away from traditional hard disk drive types of storage into cloud storage. But at the same time, the consumer products division actually was down about 13%. So that was actually a weak point in the earnings. But nonetheless, overall, it was a pretty robust report. And the trends for earnings going into 2025 are quite positive for Western Digital. And that includes other companies in the same space like Micron and Seagate Technologies. But one of the underlying components that is, I think, a little bit of a hang-up in why we're seeing the stock sort of balanced today, slightly higher or slightly lower, is that you have quite a bit of debt relative to equity, and that's always been a concern for Western Digital. But nonetheless, the analysts overall are still positive. Just to give an example of a couple, Wedbush actually remains an outperform rating with an $85 target. If you look at Baird, they increased their target to $100 from $65.
That's really good. Sometimes we see the target moves a few bucks, but that obviously shows the confidence. Tell us about your example trade.
Correct. Yeah, I think the analysts, Nicole, are expressing looking at 2025's earnings, which are quite high compared to 23 and 24. And so with that said, irrespective of today's balanced movement, the trend is still intact. If you look at the 50-day moving average, the stock price seems to respect that. So I'm going to play this as a trend continuation and give it some time. And so what I'm going to do is structure a trade going out to July with about 84 days to expiration and purchase an in-the-money $65 call option. It's a very simple trade. It's deep in the money with about a 70 delta on that option. So altogether, it would cost you about $8 a share or $800 a contract in debit. So ideally speaking, we need the stock to continue higher. Break even by expiration is $73, but there is certainly unlimited profit potential beyond that.
All right, thank you for that. George Sillis, great to see you. Appreciate it. That's it for Western Ditch right now. In the meantime, we're going to turn your attention for our 360 round straight over to the tech earnings that we've been seeing throughout this week. And we have Adam Lampe with us, CEO, co-founder, Mint Wealth Management, and Corey Johnson, Chief Market Strategist at the Futurum Group. And there's really a lot of excitement surrounding Microsoft and Google Alphabet today. 17% revenue growth for Microsoft, 15% revenue growth for Alphabet, and also seeing the dividend and the buyback that people didn't necessarily expect. Adam, I'll start with you. When you look at some of these big tech earnings of this week, which stood out to you? Were you extremely disappointed or maybe very excited about one or two of these?
No, I'm certainly excited. I mean, I think the thesis that...
Oh, he's excited. I'm excited too, honey.
Saying that AI is going to represent 10%
you and I get along real well.
Global GDP growth is really coming to play. Large dividend value stocks have historically been really great, but I think the thing that's going to really drive this market is the AI. And companies that are very well positioned to do well in this are the Microsofts of the world, the Googles of the world, the Apples of the world that have a massive amount of cash and can invest in this technology.
Yeah, and look, I mean, right now we're seeing Alphabet up about 10%. We've seen up arrows from Microsoft. We'll hear from Apple next week. Are all of those buys in your mind, Adam?
Certainly. I certainly believe that. I mean, let's be honest. I think there'll be core holdings for your life and my life combined, unless things drastically change. I mean, do we think these stocks are going to be the next the Kodaks of the world? I don't think so. They have market share, and that's a big deal.
That's a big deal.
Look, there's certainly a feeling that another revolution in technology is happening. We saw Meta sort of stating how much they plan to spend on AI, and the big spend is on. And maybe they all need to do that to remain competitive. Corey, what stands out to you? What do you love or what do you not love particularly?
There were so many earnings yesterday. My head was spinning when you were talking about Intel earlier. I can't believe it was only last night. Look, you talk about the big spend. The number that really jumped out at me yesterday was the $12 billion that Google or Alphabet spent in the first quarter on capital expenditures. And on the conference call, CFO Ruth Porat said
I
that
just saw something on my
for AI
video.
data center. So think about what $12 billion in 13 weeks is. That's $941 million a week to build out AI capacity. So to Alan's point, these companies have the money to spend and are spending it to develop AI capabilities. I think what that also means is what we think we know about AI right now, and I think most of us know that we know there's a lot, we don't know much, is going to be so different in the very near future. If you look, for example, at what Google's doing with Gemini as part of Alphabet, it's just fantastic, and it wasn't there even 10 weeks ago compared to what it is right now. So it's we're seeing really fast, really stunning developments because they're spending billions and billions and billions and billions of dollars. It's an astounding thing to see.
Is Microsoft your favorite player because it is the AI leader in your mind?
What's so interesting about Microsoft, I was thinking about this last night and talked about it on my podcast last night, was that, you know, Microsoft was in this conundrum where they hadn't built AI and machine learning capabilities like Meta and like Alphabet back when they were called Facebook and Google. They were working with AI. They were using AI to put results in front of people, kind of under the hood. There was lots of AI there. Microsoft didn't have as much. So they very adroitly made partnerships, made massive investments in open AI, working with competitors as well, to get up to speed, recognizing that they were behind, even though none of the users might have recognized that as well. And I think what happened is they really leapfrogged everyone else by putting AI capabilities into their consumer and business-facing products really early. And what you heard from Satya Nadella on the conference call was really interesting. The growth at Microsoft was really the cloud business growing so fast, Azure growing so much faster than the rest of their businesses. And he says the excitement about ChatGPT had corporate customers moving their compute to Azure so they could be closer to ChatGPT, and that they're taking market share. The suggestion is they're taking market share away from AWS and away from Google. We don't know if that's true or not, but that's the suggestion that he gave us. So because he made these partnerships, and because ChatGPT is so exciting, you had businesses moving to Microsoft, and you saw that amazing 17% revenue growth. I mean, think about, here you have one of the biggest companies in the history of humankind growing at 17% year over year. It's just fantastic.
Yeah. Adam, you know, you were talking about TikTok and maybe how Meta could be the beneficiary there if they have to sell off, or, I mean, obviously we've seen some legislation put into place this week, but, you know, Meta got walloped this week and noted how much they have to spend, at least $10 billion on AI. We just finished talking about the Microsoft and Google spend. I mean, the $12 billion capex from Google, for example. You know, what did you think about what you saw from Meta?
Well, I mean, let's be honest. Meta's a no-brainer when it comes to profiting from the AI revolution. I mean, we got 170 million users on TikTok, and let's say there is a ban. That is a lot of market share. And I love stocks that have potential to get a lot of market share. And AI is here to stay, and companies like Meta that are flushed with cash and have money and have revenues that can take advantage of this for companies that I'm interested in. I'll be honest with you. Meta's
he's going to be honest. When someone says that, don't trust him.
TikTok being banned I think there's a lot.
Somebody ever says that to you, I'm going to be honest with you.
Yeah.
Walk away
And
from
what
them.
about Apple next week? I mean, would you both buy into Apple, for example? Quickly, Adam.
Well, I have a lot of clients that are Apple executives, and they're flushed in cash. And Apple, they're like the Microsoft of the world, but they do have some challenges with China coming in. But Apple's a core holding that I think most investors should consider holding.
Mm-hmm. All right. What do you think, Corey? Would you basically hold all of these? Because what about Meta, which got walloped, and Apple for next week?
Growth stocks have to grow. Apple's not growing. Tesla's not growing. We see what happens to those stocks when they
Jeff,
stop growing. And so Apple's really struggling to grow.
Who is
It's a
this guy?
fantastic
Bad
company that
mouthing
makes
Tesla.
fantastic products, but that doesn't mean it's going to get a lot bigger.
I don't like
especially
you.
with the challenges, as Alan suggested.
I don't like you. Why'd you mention Tesla? You idiot.
The numbers that we saw suggested weak numbers from Apple, weak production from Apple, and it's a challenging time. Long term, maybe it's great. I don't know. Short term,
You don't know
it's
shit.
gotta grow to grow.
Corey, did I leave out? I mean, I'm out of time. Is there any other name that you absolutely love that we didn't talk about today? No explanation, just the name, Corey.
There's so much love to go around. Such a beautiful day out.
All right.
Who said that?
Adam Lamping, Mint Wealth Management, Corey Johnson of the Futurum Group. Great to see you both. Thank you so
Love
much.
is in the
Listen,
air.
assets jumping in. At least we got
How much I
Tech as a
miss
win in
you.
this final trading day of the
Love
week.
is
Thanks for
in the
being with me.
air.
I'm Nicole Petalides here on Trading 360.
I wanna kiss you.
Download our free Schwab Network app. It's available in the Apple App Store. 24/7, schwabnetwork.com. I'll see you at 2 p.m. Eastern Time for the watch list. Fast Market is next.
Goodbye. $5.14? Are you serious? $5.14. Okay. Yeah. 514 or 512.37. I like that 514 too. drink bourbon on. Yikes. Triple bottom on the 200. Excuse me. Yeah, give me a second. Knock, knock, who's there?
How you doing today?
All right, sir.
That's good. What am I fixing for you? The handle.
Yeah.
Okay.
You need to get on this side? Need more light?
I think this should be fine. It looks like it just needs tightened down a little bit.
Yeah. Dang, I forgot what chart that was. Google. So this spy right here, we got the head and shoulders. Once we hit that right shoulder, we pulled back. Now we got a triple top, triple bottom. So if that doesn't hold, we could knife down. Or we bounce off that triple bottom and come up and do a double top on this head and shoulders. Hit that right shoulder one more time. And the RSI is dropping.
You should be good to go, sir.
Hey, thank you very much.
No problem.
I'll put a good word in for you.
Do what?
I'll put a good word in for you.
Thank you, I appreciate it. You need anything else, I'm sure you let us know.
You know how to play guitar?
I know how to play bass guitar a little bit,
Do you? Good.
but not that yet.
Get you one of these days.
Yeah, I should.
You have a good day.
You too.
You're funny, Jim. You are one funny clown. Baba had a pop this morning, or after hours. For some reason, Baba did, after hours on the 25th. Alibaba currently up 6 consecutive days on track for the longest winning streak since 2023. Is there a risky leap to bond management starting to pay off? But is Bazone's risky leap into brand management starting to pay off? UBS upgrades China stock amid valuation collapse. How long have they been pumping China? Since last year. And they keep pumping it. Now, I did hear something this morning about some kind of number that was up. And I don't remember what the number was, but I'm pretty good at catching this. I haven't even really traded China in, I don't know, a couple of years. We got a 1, 2, 3 setup for LI. I mean, it's pulled back quite a bit since that last run. God, look at that snake. Yum, yum, yum. Nile. Now, the little kid's pumping AMC. He's been pumping it for a very long time. I feel sorry for this kid. He's new to trading, so, you know, and he's not a bad-looking kid, and he has a way to maybe persuade people. And I get on there and I just kind of set him straight every once in a while. That one bad dude that was in UFC, I can't remember his name. He got busted last year for human trafficking or something like that. He was I don't know if it was Rumble. It might have been Rumble. Rumble, RUM. So he was pumping Rumble, and I messaged him on his video. I said, it's not because of that guy, it's because of Trump. And I showed, what do you mean? And I showed him the article. It had nothing to do with that redneck, that punk that smokes the cigars and I do believe this is a day trading stock right now if you know how to trade. And we could be setting up for something, but I called this bottom down here at $2, and I waited and waited and waited and waited and waited and waited. And I saw the 238, and I thought about jumping in that sucker. I'm sorry. I mean, look, it's up $1 in a week and a few days. But I waited so long for this thing to pull back. I mean, look at it. This kid was pumping it up here at $10. And he kept pumping it, doing video after video after video after video. And I said, man, the movie business sucks. You got to be in the now when you're trading this. This is one of the, I told him, this is one of the most shorted stocks and one of the most biggest meme stocks out there right now. If you trade this stock, you need to know you're taking a big risk. It's not about putting your life he put his life savings in it. I said, there ain't no way I'd put my life savings in this thing. Eventually, maybe, but they're so financially broke. I said, the only thing that's going to make this trade run is news articles or momentum pumpers. The fundamentals suck and the news is horrible. So I said, I told him, I said, I'm waiting for 2 when it was at 5. And that was about 2 months ago, right here. Almost 3 months ago. And I just slapped myself for not taking that trade when I called it out. AMC. I should have traded. I want to watch it because I mean, that would have been a good spot right there yesterday. I would have took that probably. Now you got a double top. Warner Brothers Pictures and HBO acquired groundbreaking doc. AMC enters hedge holdings options frenzy. What you need to know. Holdings options frenzy. Okay, investors with a lot of money have spent to taking a bullish stance on AMC. This was on the 25th. Retail traders should know. And what did I just do? Here. That's funny. 1, 2, 3, boom. 1, 2, 3, boom. 1, 2, 3, boom. Inverse head and shoulders, boom. One, two, three. 1, 2, 3. Easy as ABC. 1, 2, 3. Baby, you and me. Three, two, one. Do I have an iron condor coming today? No, but you mentioned one. Looks like it's paid off on both sides. You did show it to me. The iron condor. Trying to figure out what kind of song I'm going to play today. $508.88 needs to break. Come on, baby, let's take it to 50942. Because I remember these white soldiers here with an inverted hammer. Google. You have been a good trade, long off the 38 Fibonacci. Yes. And I think I had it off the 50, Mike. Unless it pulled back more. I think it did pull back more. Yeah, I had it off the 50. How'd you set it up? This is how I set mine up. Bingo, baby. SPX2. Tesla? Oh yeah, Tesla's back in my cross lines. AMC new high. Was just looking at it. Well, I think we're at a bottom, and it's really scalpable right now in day trading. Maybe a small position for swinging, but you know it was a lot better a buck ago. I won't think I'd chase it here. It's not a chaseable trade. I mean, it'll pull back and then you'll get a good chance. I swung a few of them, but Apple down. I didn't hold too long. Adobe. Let's see where my new screen is here. Oh, shit.
It's about it was 68 cents, moved a little bit. It was 68, now it's a 70% probability of out of the money.
Spot.
So you're selling a high probability short put vertical on a stock that sold off $30 that is risk defined and collecting data. Like I said, just be careful of the liquidity in this name.
Yep, and a price discovery, as Kevin and I always like to say, is if you want to collect $3 like we've got here, then maybe put it in at $3.50 and then cancel replays. You can do that and work that number down because the bid-ask spreads are so wide in some of the options. But let's go through this one. May 24th, weekly options, 28 days to expiration, as Kevin mentioned. Sell the 275 put, buy the 265 put, collecting roughly about a $3 credit. That might be a work in progress because the stock has moved up, which decreases the price of it. But that would take your break even down to 272. Kevin mentioned the probabilities of finishing out of the money on that one over 70%. At this point, you've got some assignment risk on that short option going into expiration if it settles between there. But Kev, when you look at this, people will say, well, you know, why do you do this? It doesn't seem like on a $10 wide spread, you're only collecting $3. You got $700 in risk. But these are the trade-offs that give you the higher probability of success, right?
You've got $15 on the downside before that short strike is threatened. That's going to cost you something. And what it costs you is you don't get, you know, the risk reward is weighted to the other side. But you've got a high probability of being successful on this trade, and therefore the trade-off is you don't get the beefy premium. Like I said, if you want to buy this vertical at $3 or $2.50 or wherever it's trading, you need a $15 move and then the premium to break even.
Right.
You're on the other side of that.
Yeah.
You're playing the high probability.
And some people might say, well, why don't you buy a call vertical for a bullish type of trade? But better probabilities. I mean, the stock can still move lower on the short put vertical, and you can still make money if it stays above 275.
Sticking to the math, the high probability trade, that if you make one trade, if you want to narrow this down to one trade, yeah, you could be right, you could be wrong. But what if you make 10 trades a day for 220 trading days?
Yeah.
Playing the probabilities works.
Yeah. All right. Great discussion there on the short put vertical in Spotify based on that Likefolio data. All right. Coming up after the break, we're going to take a look at onsemi. The industrial chip maker stock is down nearly 20% so far this year into earnings on Monday morning. Fast Market will be right back.
I like that music. But I don't like that.
Binge watch the market with Schwab Network.
So it's time for Washboardjim's premature fat cat watch list. And let's see what we can pick out of a watch list today. Let's look at the hammer. I want to look at the hammer. If I can find a hammer. Let's see, ETFs. There's 9 to 5. Nile's up today. It's not the right chart. Where the hell's my little chart at? What is the deal with this today? I got two. I'm gonna go through all this weekend. I got too much. No, that's a bunch. That's the VWAP. No want. Yeah, I gotta thin out these. Nile's looking real good. It had a breakout today. Nile did. Behind the scene of Nile's latest to boost TV sales.
The distance you can go in that car and how long it takes to charge, George, it looks like if EVs recover, so will on semi.
Yeah, that's the thing, and it's important. I think you bring up because if you look at the chart, I mean, at least the last few days, it's gapping higher, and it's got a little bit of a continuation. So I think the correlation with Tesla is certainly there, and so that just gives you, an idea that, the reliability for on semiconductor on the EV space is very large, and again, the challenges for the EV market are long-term challenges, and that's where you have to consider on semiconductor is placement as a stock. So. There's another stock out there, Enphase, that's, was down on earnings, and it wasn't because they're not profitable. Their profit growth and revenue growth is down. And I think that's the same case for her on semiconductor, with Enphase being more in the solar space, but nonetheless in the alternative energy space. But, looking at the chart, if you consider on semiconductor, $58, it's about its 200-week moving average. Now, I'm not saying that's going to be an area of support, but generally, for stocks that are profitable, major reversals happen at the 200-week moving average. We're talking about long-term reversals. So we'll see if it holds. I think it's an important level for this company. And if they actually can raise guidance slightly, that
I remember I got that from.
Continuously further for this name.
Yeah, and I know also they're trying to grow those gross margins. A little bit of cost cutting, maybe some efficiencies coming into play there also. But some of the names in competitor names in this space,
Gold Star worked instead.
Underperforming severely, having really good weeks though on the back of Texas's report.
Texas really $9.
Yeah, exactly. It's actually up 12.8% so far this week alone. All right, great stuff as always, George. Appreciate it. Have a great day. That's George Tillis, Senior Markets Correspondent. Kevin, so the first thing that stuck out to me going into on semi, you don't have an anticipated market maker move in there, but if you go out to next week's May 3rd weekly option series, about a $6.50 move either way in the shares is what they're pricing in. But remember, you're going to have 4 days of time decay or theta in those two, so it's probably going to be about a $4.50 move in the shares either way that they're pricing. They report Monday ahead of the earnings on this one, 68.46. It's already made a good move, as I mentioned, up nearly 13%. So I looked at a strategy that is one of Kevin's special. I would call this one the Kevin Special. It's a customized trading strategy here.
A better name, but okay, let's get started.
The Kevin Special here, where we're combining two strategies to create a single strategy, four-legged spread. So out in that May 3rd weekly cycle that expires in 7 days, we're going to sell the 64.61 put vertical. That's $3 wide short put vertical to help finance the purchase of a 1 week wide call calendar to the upside. We're using the 73 strike, about what the market's pricing in, that 1 standard deviation move here on the 73 strike. You're collecting credit of roughly about 40 cents. It's probably closer to 30 cents right now, but you are collecting a credit on this one. Kev, when you look at this one, you want it to go to the apex of profitability at or near that 73 strike, but everything above maybe 63.60 break even is going to be profitability on this.
A bullish calendar financed by a bullish put vertical below the market. As long as it doesn't breach 64, right, because you do it for a credit, you're profitable. The risk on this trade is the $3 spread below $64. So probably $260 is where it maxes out. Yeah, $260 is the risk. It's the $3 put vertical minus the 30 or 40 cents you've collected in terms of credit. Where it peaks out, obviously you're doing a call calendar for a credit is the whole package.
Right.
So you want it to go to that short strike. Whichever one you pick the 73.
Yeah, and I mean, on this type of strategy, because you're taking the credit on it, Kevin, you don't want that blowout where the stock goes up 2 or 3 standard deviations. But if it does, because you took that credit, you can still be profitable, right?
Right. You don't lose. You only lose below $64 on the downside. That's where the exposure is.
Yep, that's right. So good look at that. You get some assignment risk on those short options going into expiration over the next 7 days, but this report's on Monday morning, so you get an idea of where the stock goes. Does it pop like Texas Instruments, or has it already made the move? This is an example reflective of a bullish trade about a 1 standard deviation move. Before we go, Kevin, real quick, looks like we're gaining strength into the close, but we got a big week next week.
Amazing.
What do you have for the Donald? Did I put it in the room earlier?
Payrolls on Friday, a lot of earnings during the week. Apple, Amazon, big week again.
I have 41.87.
Fed meeting on Wednesday.
41.87.
All right, that's going to do it for us today here on Fast Mark.
I got 41.87. Oh gosh. SPX. I'll take it. My 51.10s are up nice. And the Donald. I was going to do the Donald here. I got the Donald. I got 41.87. Oh, we already broke it. I have 45.21, 45.21, 45.21. That'd be real hard to get to, I don't know. 45.12. That's a triple bottom. 1, 2, 3. On the hour time frame. Is that what you got? C up, yep. If you watch Mike, he constantly does what I do. He has a watch list and he goes over them every single day. Seems like almost the same stocks. Or at least in a sequence, in a period of time. I got 45.12 next. The union, New York, Donald, I got a video, Donald going to court the other day, and the union showed up. And the way the union talked, it sounded like 3 out of every 4 were going to vote for the Donald. They are sick of what's going on down at the southern border. That takes jobs away from the union workers. So think about that. Biden says he's a union man. Then he brings 12 million illegal criminals over the border and pays them $15,000 a month, more than what the vets get. I'm telling you, we're getting screwed. They're buying the vote. One of the most scandalous administrations I've ever seen in my life. Scandal, scandal, scandal after scandal. $15,000 them kids are getting in New York. Every single one of them. Oh, I didn't see your alert this morning. I didn't see your alert. Yes, I would have, because they were all down. Where'd my TV go? What happened to my TV? A lot of missteps today. What'd I do with it? God. It's incredible. What do I got that on? I have no clue. Cancel. Exit program. This was said right here on this very channel, whether I choose to believe it or not. I believe it. SPX to the moon. Uh-oh. Can you tell me approximately what time this was? When this message was released? Magnificent. That'll determine what kind of grade you get. Exxon. I'm going to give a quick lesson right here. YouTubers. Let's say we came in first thing this morning. Let's say, are we having a breakout? 1, 2, 3. Bulls won at 510. By darn. The video having a great day. Do we know why NVIDIA is up so much today? I'm watching it right now. I called a snake breakout pullback boom. We're going to find out. NVIDIA stock rises. What Microsoft says Google CEO said about the chip. NVIDIA is rising Friday on the earnings report from the big technology. What? NVIDIA stocks was rising earlier on Friday as the latest earnings report from big technology companies showed continued investment in artificial intelligence. Can't find my TV. We got fat cats are back. Fat cats are in the building. Oh, I was going to give a lesson here real fast, but I got been helping somebody out on the side here. Find my We might have seen some resistance here on the SPX. If you're in the trade, we could start to see a pullback. Rising wedge. You're not seeing overhead sellers on the SPX? I'm seeing resistance now. You're not seeing any. We got a rising wedge. $51.03. For it to go down to the 200 SMA, if it does not hold 51.0862. VIX, a falling wedge on a different time frame. There it is, baby. Nailed it. 3 black crows. SPX, you're coming out of the multi-day double bottom. Target is 51.37. To the upside. Oh. Well, we're going to know right here any minute. I don't want it to break this line. I feel like buying a put, just to prove you wrong, but I'm not going to do that because I did that. That don't work too well with you. No, I'm going to give a shout out to Mike. I haven't done it in a while. It's true. He's probably the 10th best trader I ever met.
Thank you very much. That's really nice. Thank you.
You're welcome. He does more research than anybody I know, for one. He's more articulate, number 2. He's has beautiful charts, colors, number 3. And he changes his underwear every day. Figaro, are you calling? Running around. Oh, yeah. Gold Star work instead. How are you doing, YouTube?
Which is a good sign, but at the same time, they're expanding their operations quite aggressively, and that's been costly, and that's indicative of why we see pressure on the shares every time they report earnings, and even if they beat, the stock does move because the short interest is quite high, but the pressure on the shares has always been share issuance. They have to finance that expansion, and that's why
This is Sophie.
It's still, still low from a relative standpoint to its own historical price action, but also compared to,
being in the now. I talk about being in the now. Well, I know that a millionaire has a big position on this stock between $6.50 and $7, and he's been buying the dip and adding on. I don't know. It's been a while, so I don't know if he's still in it or not. But I do know that. I remember that because last time we called this out, it was up there, and we had a big sell-off. And I read an article on the pullback.
30, and now we are a little bit higher than the last time we.
And there's a guy that said that was it.
It's a good question because one of the things I think is important to also know about SoFi or any business or financial services business is you have to separate the portfolio risk, which is essentially the loans that the company underwrites on their existing on their balance sheet, versus the actual corporate risk. And so I think, when it comes down to portfolio of lending, higher interest rate environments help lenders. There's also going to be, higher reserves set aside to offset losses based upon, some consumers, falling through the cracks, not able to pay bills because of higher rates. That is separate from the business risk. And the business risk is this company, outside of its loan portfolio, has to finance its losses. And I think that's where the challenge lies for the stock. So to answer your question is, I think the loan portfolio is balanced. I don't see anything wrong with it. But I think there's some issues still going on with the business in terms of them growing aggressively, because in the long run that's going to work out, but in the short run might be multiple quarters or even a few years, that it's going to put pressure on the stock price because they're continuing to issue shares to finance their aggressive expansion.
George, I'm going to give you kind of a tough kind of analogy in a different space, but to try to illustrate what I'm about to ask you about. Netflix had the first mover advantage when they kind of pioneered streaming. We've watched legacy companies like Disney struggle to do so. Legacy companies like HBO and Max struggle to have that same type of excitement around the same service in the end. SoFi is a mobile-first company. Their whole shtick is it's all in one app. They're targeting the younger demographic or those who are on their phone, they're not on computers. The other banks are trying to create apps and catch up, but not alienate their existing customer base. How important is it to be kind of targeted in what you're doing and be the first or maybe the best at doing something?
Well, obviously, if it's a new technology, being the first, having the first mover advantage is extremely important. I mean, look at Netflix and streaming, media. That was sort of a first mover advantage because it was a new technology. So, you think about financial services in essence, from a broad speaking standpoint, has been around for centuries. It's adapted over time in utilizing technology, but lending really is the same as it was from the beginning of time. So, sort of like insurance services. So, if you think about SoFi, the comprehensive technology they offer altogether is a value proposition. But you have to consider, is that value proposition better than the competition? Are they improving profits more so than their competition? So these are questions you have to ask yourself about, investing in this company. So, I wouldn't say,
even Boeing's up today.
Different than any other company, but they do offer it in a comprehensive way, which again might be different than any other company, which is, again, maybe their standalone value proposition.
And I have to say, George, anecdotally, that I do know several of my friends and peers that now do use this service. So they've done a great job marketing to this younger demographic, and I guess it's working because it's constantly coming up in my circle, which is surprising to me. But hey, good news for SoFi shares, which are higher today ahead of those numbers. But we will leave it there. Great insight as always, George. Tell us, thank you for joining us all week long for Next Gen Investing, and that'll do it for Alex and myself. Have a wonderful weekend all. Coming up next, we have the watch list with Nicole Petalides.
She's talking about numbers. I don't see any numbers. Sophie. Buying votes with other people's money, says Elon Musk, as Biden announces additional student loan forgiveness program. Bill Ackman calls it illegal. It is illegal. He's bought a lot of votes, man. He spent trillions of dollars buying votes. Billions. The southern border, 11 million. And I don't know how many million of students that get... It pisses me off so much. I mean, I worked so hard. I worked 2 jobs to pay off my student loans. I didn't party. I didn't drink. I worked. I worked hard to pay them off because I signed a contract. And I was responsible for myself. And now these punks are getting free ride. It really pisses me off, man. I could, give me back my 40 grand,
Don't give me
I even went out and got me a GED. I changed my life around. I could have been looking, maybe, I wasn't a good kid. I wasn't a thief. I wasn't that. But I was just mean. Didn't have no direction. Until one day, I met Sam Walton. I was inventorying Walmarts at Sam, and a guy comes up to me and he says, "Son," he says, "could you connect me to the shampoo department?" And I looked at him and I said, "You mean the HBA department, the health and beauty aids?" "Yes, I'll walk you over there, sir." And at that time I inventoried Walmarts. And so that day on, when I met him, I said, "That's it." I went and I got a grant. I have epilepsy, and I was able to get me a grant through the government to pay for my college. So I was thankful for that, but I still had to get money out and pay for extra courses and things like that. But after meeting Sam Walton, just like a light just kind of beamed in my head. Here's an old man, drives an old beat up truck, and he's a billionaire. And Sam Walton's from Missouri. That's my story.
Talk about the very latest earnings and the big moves we are seeing. Microsoft and Alphabet Group.
But I want my 40 grand.
In the meantime, we will break down this morning's PCE report and analyze how the Fed may incorporate this data.
And let me tell you, it didn't stop there. I had to find a place to live. So I got into this old junky trailer house. And I wanted a job. I like to work. So I walked around. I had experience in picture framing, just a little bit. And I walked up and down the streets of Sedalia, Missouri. And at that time, it used to be a railroad that would go through there called the Katy Trail. And be back during World War II, and Scott Joplin was from there. And the blacks would live on the other side of the railroad tracks, and then you had the city, the city on the other side. And Scott Joplin, if you know who he is, he's a piano player, and he's very popular, and he had a bar, and on that bar was Main Street, so I wanted to go see it. And I went in there, and it was an art gallery, and I said, "What the heck?" I put my fist down on the lady, and I said, "Honey, do you mind if I work for you for my internship? I got my GED, and I'm going to college, and I'm in student government, and I'm in Delta Epsilon Chi, and I need to get me an internship, and I'd love to work for you for free." About 6 months later, she started losing her eyesight, and I asked her, I said, "You don't mind if I take over your business? I'll take over your bills, and I'll pay off all your bills, and just sign it over to me." So Scott Joplin Bar had a gallery, and then that's where I opened up, where I had Picture Frames Plus. And it was just like overnight, Sam Walton made a whole new, just looking in his eyes just changed me. So that's that. We'll get back to stocks.
Pretty muted response in terms of the 2-year note, the 10-year note, and yields in general. They're actually pretty close to unchanged, but slightly down on the day, Nicole.
Yeah, pulling back a little bit. We did see the 10-year hitting the highest in 5 months, highest levels, and of course the Fed is watching all of this, unlikely to see a cut anytime soon, that's for sure. Tell me about Intel not doing well today.
No, in a time when chips are so popular, such a high-profile earnings report, Intel down right now about, let's see, I've got Intel trading down right around 10% lower this morning on earnings of 18 cents. That beat the 13 cents per share estimate, but revenues were light, 12.72 billion versus 12.76 billion. Revenue growth, 8.6%.
You got a triple bottom.
Revenues for the second quarter of 12.5 to 13.5 billion. and earnings per share of 10%. So with everything going on in chips, with everything going on in AI, a very disappointing earnings report by Intel.
God.
Currently down 10%, Nicole.
Yeah.
Unbelievable.
Understood. Thank you so much.
Say it, honey.
It's great to see you. Appreciate it.
So,
Look at the bigger picture. Jimmy Lee's with us, CEO of Wealth Consulting.
we've got a three-headed snake.
Right now, I just checked, and the S&P for this week is up 2.8%.
2886 would be a good buy. That's where I'm gonna set my close to my alert.
A lot of winning weeks, and we pulled back a few weeks, so now we're back in the green for the weekly number. Couple of days, though, with some big selling. The volatility's back, that's for sure. What do you think?
2961.
Good afternoon, Nicole. You know, today is I think mostly about the great earnings reports from Alphabet, Google, and Microsoft participating, as you said. And I think the PCE numbers are calming people that the economy is okay. I mean, you know, 2/3 to 70% of the economy here in the United States is due from consumer spending. And the personal expenditures number today in the PCE, I think, gives confidence that people still are spending. And the savings rates might be down a little bit, but they're spending. And let's face it, you know, the reality is that the job market's good. We're still creating jobs here in the United States. Unemployment's low. I think employees, workers are earning as much as they've ever earned, and they're spending the money. So there's enough confidence, I think, in the consumer to continue spending, and I think that's what's helping the rally today.
Yeah, understood. And look, next week we have the Fed, May 1st. You know, we'll hear it's May, June, July, and September. Are you expecting any cuts at any of those meetings?
I am. I think we should probably get at least 2. You know, I'm a little disappointed that inflation data is not better, but I think investors are actually getting comfortable with this, you know, higher for longer idea. The economy is holding up. I mean, there are certain sectors of the economy that really does suffer from interest rates being as high as they are. I think the Fed should actually lower rates, you know, and the whole target of 2%. While they say that, I think the idea of inflation being under 3 is good. And, you know, I think the Fed might be thinking about making sure that inflation doesn't rear its head again in the ways that it was during COVID at you know, 9%, double digits in some areas. But we're not anything close to that anymore. So I think inflation is still okay and headed in the right direction. You know, it might be kind of leveling off a little bit, but I think we're okay there. And I think the Fed needs to cut so that we avoid the economy suffering more and possibly falling into recession. So that's what I'd like to see.
Yeah, understood. I mean, there is concern about the economy slowing. Yesterday we got that GDP print while folks were spending, right? And, you know, we see consumer prices higher and things like that. So inflation is real. But at the same time, with slowing, are we concerned that a cut could mean recession or a hard landing or something like that?
I don't think so. I think interest rates should be lower. And, you know, I think business is still cautious. And so we're seeing some manufacturing data that would support why the GDP is slowing as far as I could see. And it wasn't really a huge surprise to me. But I don't think the rest of the year is going to end up that way. I think that the economy is doing well enough in the United States to have a good year this year. And I think the market's sold off a bit just because we had a 10% first quarter. And that's a very robust first quarter in return to the S&P 500. So what we're seeing, though, is investors are buying on the dips. And I'm at a conference, actually, in an investment conference. And yesterday I heard that from one of the economists that, you know, $6 trillion currently in money market funds, but another $19 trillion in deposits. So there is a lot of money sitting on the sidelines. And while the 10-year Treasury being close to 5%, I think for some of the longer, you know, term portfolios, that investment's going to get some attention. I still think that you have a lot of opportunity in risk assets. I think investors should be positioned for a lower rate environment and not wait, because I think there are certain asset classes like real estate and longer duration bonds that'll snap back very quickly when the Fed finally does cut, and it'll probably happen before that as they're signaling that.
Right, yeah. Tell me more about the sectors. I mean, you just mentioned real estate, but I knew financials were on your radar too. Do you think these are sectors to buy into right now?
We just did some rebalancing for a lot of our portfolios, and we've increased our allocation into cyclical sectors such as industrials, And we do like interest rate sensitive sectors, and so we think that rates are going to be lower. We don't think that the Fed's going to hike like some people think. That's obviously not a very popular view, but some people still believe that. I like the fact that investors haven't chased stocks. So a lot of investors have missed this bull run since the lows of October of 2022, which is good. There's a balance there that not too many people are chasing, and there's enough people out there that are very smart and prominent in the financial world that still believe that, you know, we face a lot of risk and that the economy could go into a recession here in the United States. You know, the geopolitical risks that we're seeing today are real, and that's a big concern. But I do believe that there's enough dry powder on the sidelines that if things start to look better and the Fed starts to signal a rate cut, whether it's June, July, or whenever it happens, I think there's a lot of money that could be rotating out of some of these defensive areas into sectors that are more cyclical and will do better. And so I think investors should be positioned for that.
You know, we watch tech. I mean, today we're seeing tech that's doing so well, right on the heels of what we've seen with Alphabet and Microsoft. But there's still folks who think that the 10-year bonds, overall yields can continue to go higher. And that, I mean, usually can pressure tech or risk-on type of assets. Do you see the possibility of bonds going higher? And if so, how high?
Sure, I think there's a chance that rates go higher. I mean, if we get some inflation data that we're not expecting on the high side, I mean, the 10-year could approach 5%, but I hope that's not what we get. But I don't think that's going to be a big deal over the long run, because I don't think that this type of inflation that we're seeing now is spiking in such a way that people try to compare it to the 70s and 80s. I just don't see it. And so I think the Fed holds tight here. They could hold tight for a while, and if inflation data doesn't come in better or lower than what we're seeing yet right now. But I think overall, at the end of the year, I think rates are going to be much lower. And so if you think about the 10-year potentially going down, you know, 0.5% to 1%, think about what asset classes are going to look like in terms of returns between now and then. And I think that's what investors should be focused on. And we're long on tech as well, and overweight tech still going into, we think, rate cuts. And again, like I said, I think while bond investors have been waiting for rates to come down and get some of their money back that they lost in 2022, and it's been tough this year as rates have been climbing, I think bond investors will, at the end of the year, will be happy with their parts of their portfolio that are in fixed income that will benefit from lower rates as well. And we're also leaning into small caps, even though that's not popular today, Nicole.
Yeah. Yeah, understood. Look, a lot of people have been waiting on those small caps. They'll participate soon. We will see, right? I mean, I know a lot of people love them. Jimmy Lee, Wealth Consulting Group. Great to see you, Jimmy. Thank you. Coming up next, we have plenty of stocks. Dan Ives is standing by, and he'll give you some price targets and some big names like Tesla and Microsoft, too. We're also watching Palantir. Our team is ready.
Pop da pa cha boo. Yeah. Ooh. Ooh, yeah. Ooh, 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 yeah. Oh, yeah. Do, 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 do. Oh, yeah. Okay. I love music.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure
that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community. Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. I'm Nicole Pedalides, live on the floor of the New York Stock Exchange. I have a lot of movers for you to keep an eye on. We have so many names to cover. How about Skechers? That's up about 13% after a big earnings beat and raised its guidance. The sneaker maker saw 17% growth in its direct-to-consumer segment, as well as 15% growth internationally. In fact, international sales accounted for 65% of the company's revenues last quarter. Snap, big move, popping higher, huge beat. Revenues increased 21%. And the company said improvements to its advertising platform led to its first double-digit revenue growth in the past 6 quarters. Snap said Snapchat Plus subscriber revenue nearly tripled year over year, and that stock is up 27% right now. And this one's down 20%. Missing on the top and bottom line is a trucking company and said it did not see the anticipated seasonal increase in truckloads during March. So the company also announced that the chief financial officer will be retiring. And Roku, this one's down about 8%. Despite a double beat, the company said it faces difficulty year-over-year growth rate comps due to a previous price hike. And let's take a look at Bitcoin. And this is at 64,570. In the meantime, back to these markets, a winning week on Wall Street. You probably didn't think it was possible. We've had a few weeks of selling, and the last couple of days have been tough, but we're back in the green again. Hillary Kramer, founder, CIO, Kramer Capital Research, is with us. Thank you so much for being here. It's amazing because the first couple of days this week, we felt like rally mode, and then we got walloped. And, just this volatility is tough, right?
Well, we're in a time period where we see this volatility, and you and I have been through it before. Volatility comes first, and then we see the market try to digest months of upside. And I think that this is, even though we have a great day today, we have such strength, this might be a dead cat bounce. It's a lot of short sellers that are covering, so we shouldn't fool ourselves. It was a tough month, April. They say, sell in May and go away. May actually might be okay because April was so bad. But at the end of the day, Nicole, the problem is interest rates. We are not going to see cuts. It's become a reality. And you can't have inflation and high rates that impact people's credit cards and their mortgage rates and everything like that.
Yeah, and look, the Nasdaq's up 5.3% this year. The S&P is up 7%. So you've already have somewhat of a winning year, and it's hard to say where it will go, but we do have the Fed meeting next week. We have jobs next week. And then you start to sort of figure out how to navigate the market. What has stood out to you when it comes to earnings season thus far? We're right in the middle of it. We started with those financials. We've had a lot of industrials, of course, tech. How are you feeling about earnings season, and where do you think we're headed?
It's so interesting. So you look at Caterpillar, you look at ExxonMobil, that to me were disastrous. You look at the financials, you think of companies like JP Morgan, the big banks, and all of the banks saying, look, their net interest margins weren't as great as they expected. People are demanding 5% on their money. Okay, so the banks are really telling us something here. And except for Goldman Sachs, I think one should be very wary of what it means in the coming quarters. But the biggest news, I think, is that the AI charm is gone, right? Like, it's just done. Everyone realizes that artificial intelligence isn't all it's cracked. It isn't all it's cracked up to be, especially if you're Facebook, Meta, and if you're Google, for example, Alphabet, yes, it's amazing, everything's great, but that to a great extent has to do with their competition and really catching up with Amazon Web Services.
Right, and I know that right now it feels like like these companies are going to be spending on AI, but we're not necessarily seeing how they monetize AI. But there's no doubt that these companies are spending big, and we're going to have Dan Ives on shortly, who thinks this is the next, tech revolution. So we'll hear the other side of the coin. In the meantime, I mean, we know they're spending a lot on AI, so we'll see how they're going to use that. That being said, you do have names that you do like. I'd like to hear about some of the names that you like right now.
Okay, so even though Spot, digital music streaming,
Sure.
even though it's up well over 100% in the last 52 weeks,
Right.
there's still more upside here. I think everyone wrote it off saying that Apple Music was going to take, was going to eat their lunch.
Right.
But Spotify still does it right, and people are looking for value. And Spotify's a lot more of a value than Apple is. And then the other one, Trade Desk, is really interesting to me. Trade Desk does the advertising, and it's like the advertising network, the advertising hub for the Googles, for example. And advertising is as strong as ever. So Trade Desk is, they're up, it's 43% in the last 52 weeks, but there's opportunity for Trade Desk to go higher. And look, when you're talking about companies that are between $40 and $50 billion market caps, $100 billion isn't that hard to get to.
And what's interesting, I mean, Spotify, for that matter, has pricing power. They've seen more subscribers, to your point. So definitely seeing the growth there. And for Trade Desk, I mean, advertising is sort of where it's at.
That's
right?
that's totally where it's at.
Yeah, I mean, it did move down along with Meta. You don't like Meta?
No, not at all. I think that everyone's realizing that Zuckerberg is really a loose cannon. He wants the metaverse, and now he wants to be an AI, and he's going to put billions in it. And it doesn't. There's a loss of faith in the management at Meta is really what it comes down to. Whereas you look at a Google, Alphabet, and people love Ruth Porat, the CFO. People really have faith there. Even with Microsoft, there's just a lot of confidence in what Microsoft is doing. But I still say that there are some gems like Palantir.
Yeah.
Everyone keeps writing them off and not realizing that one day this stock that goes between $20 and $25, it should be around $22.50 right now.
Yeah.
It's going to be a $100 stock.
What will drive that? Why do you think it's going to get higher?
True artificial intelligence player. They know how to monetize it. It's just that AI, the real AI players can't really release who their clients are, what they're doing for them. And it's not as hot and sexy if you're working for the defense industry. But hey, that's where the money is, especially if you're doing it globally, all over the world.
Right.
And last but not least, there are these small players like MindMed, MNMD, which is only an $8.80 stock right now, that is going to replace, it's going to replace the traditional Xanaxes and the PTSD medications. PTSD afflicts tens of millions of people around the world, certainly even tens of millions in the United States. And there needs to be a replacement for the Xanaxes, for the ketamines. Now, some people think it's like LSD and mushrooms, but the companies like MindMed, MNMD, that's the only way you're going to get another NVIDIA. NVIDIA is already too hot. I mean, NVIDIA is falling back. But if you're looking to do 10 times on your money, you've got to do the risk reward. And there's going to be some risk, and it's going to be names that feel very uncomfortable to buy.
Yeah, I mean, Palantir, folks, PLTR, and MindMed right now, I'm looking at it, MNMD. And I'll tell you, Leerink Partners recently put out an outperform rating at a $20 target. It's only at $8.50.
Now,
so they see upside potential too. They like it.
Yep. So next summer, this coming summer, we'll see phase 3, and I think that's when we can see the jump. But you can, this expression, don't try to invest looking in the rear view mirror. You've got to look for the next big thing.
Right. Do you feel investors are going to be putting more money into the market? There's been a little slowdown for the retail investors. Consumers get a little strapped. Are they going to be spending? Money needs to flow for the markets to work, for the economy to work.
And I don't think money will be flowing as freely. We're just at a point where people have just overspent.
Right.
Now, the AI revolution, I have to go full circle. What we're going to start to see is jobs. When we see those jobs numbers, jobs are already disappearing because of artificial intelligence.
Right.
It's certain industries, and we're going to see a lot more of that. So as the jobs become more sparse, as we see people not earning the checks that they used to make, and then combining that with big payments. Yeah, sure, lots of millions are locked into these low mortgages at 3%, but you always have a new crop of people that invest in real estate, and they're not going to have the money to be sitting around investing in the market. And right now, once volatility hits and people start to get burned, this scares off the individual investor.
I see.
That's the biggest problem of all, is fear.
It's great to see you. Hillary Kramer, founder and CIO at Kramer Capital Research. Thank you, Hillary. Coming up, Dan Ives is standing by, and he loves those big tech names. He says the next tech revolution's coming. We're going to look at Microsoft and Google and even Tesla and Apple next week, right? A lot to discuss there. We'll be right back.
Changing and not the point of betting the call side in the winter from
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100.
Your dad.
When other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging.
You remember the time when your dad took us to go get some crawdads to go catfishing? These crawdads were big as lobsters. We went down to Jordan Creek, and then you showed up and spoiled everything. I thought I had a new daddy. He took care of me. We went fishing. Okay. That grade is reserved almost exclusively for Washboardjim. An F? I get an F? Minus? Oh, God. That's disgusting. What the heck? That doesn't make sense. The puts were going up when the stock was going up. This is weird. What the heck's going on here? Oh, turn on the radio. Oh, Mr. Ives.
Massive growth, but I do believe
Growth.
it's been a sobering moment for the
Sobering moment.
believers. We've seen demand come off, but you're still going into one of the biggest transformations in the auto industry in 50 years.
Are you stoned?
Do you like the triple Qs? Do you still have your IVES ETF? If someone doesn't necessarily want to buy a name or they wanted to buy an ETF, what would you tell them to buy?
Why? I mean, to me, it's really, as we've been super bullish on tech, it's really playing the AI trend. It's playing that basket.
Where the hell's
It's
my
sending
chart?
Software, and as the haters continue to hate, that's where you get the opportunity. You look at last night, that was music to the ears for the bulls. You don't need to hear anything more in terms of understanding this monetization. I see it around the globe. Traveling. This fourth industrial revolution.
God, he'd get on my
It's a
skin.
1995 moment, not a 1999 moment.
Right, understood. All right, Dan Ives, it's great to see you always. Thank you so much. Love when you're on. And let's go Knicks and everything else New York, Rangers and such. Thank you, Dan Ives. Bud Bush Securities, right? He's pounding the table on our New York teams and coming up, we're going to look ahead to next week. We have Amazon and Apple and the Fed. Will the Fed hold steady or maybe will they tell us anything? We'll discuss this coming up.
The what now? Seriously, I called that you should be careful that longer calls and rather be puts. Oh. Doom, doom, boom, boom. Da, 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 da. Doom, doom, doom. Oh, God.
Every morning, every trade, always live.
Always clean? May I help you?
Analysis, in-depth technical insights on every changing.
Always clean. May I help you?
Anytime, anywhere, on any device for free.
I am a...
Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Renner.
Trading at Schwab is now powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. It's now a winning week on Wall Street with the big moves today that were really shot higher by tech, and actually I guess I don't know what you want to call it, a Goldilocks PCE. I mean, we see a little bit of year-over-year move, but nothing to jostle the markets too much. That being said, here's a look right now, because the NASDAQ at one point was having the best day since February. It was closer to 2% at that point, but you could still see it up 1.6%. The S&P's at 5,106. That's up 1.1%. The Dow is up 0.5% right now, 202, and the Russell. But you know, you can say thank you to Microsoft and Alphabet, and those are certainly helping to lead the way today. And I guess yields coming off the tippy top off the highs. So these are some of the things that are happening in the market. Next week we'll get Amazon and Apple and hear from the Fed. So that brings me to my next conversation too. Gene Goldman, Chief Investment Officer at Cetera, is with us. Thank you for being here. So look, we've had a lot of volatility, but right now we're clocking in a winning week. And when you saw days, I mean, one of these days I looked up and the Dow was down 700 points. I know we look at the S&P, but when you see the Dow down 700 points, that's a big day. That's a big down day. We came up off the lows, which showed that people were interested in buying the dips. What do you say about equities right now?
Sure. First of all, good afternoon, Nicole, and thanks for having me back on your show. You know, listen, this year is going to be a year of volatility. We've been saying this so many times, and I think these last few weeks exemplify this perfectly. You know, we are having a little bit of a reprieve today, but you think about what's going on. You know, we've had a huge run in the market. The S&P has gone up about 27% since the October 27th correction low of last year. That's a huge surge. So you have high valuations now. PE ratio in the S&P is over 21. You've got bond yields high. You have energy prices still high. Fed uncertainty. So take all this together. We do think further pullback is likely. Maybe even a correction. Again, corrections are normal. They average about once a year. Our worst case scenario is that 200-day moving average around the 46, 86 level. But the good news, and again, there's a good news to this point, is that we think that if the stocks pull back, if the S&P pulls back, for example, you know, it should be pretty short-lived. You know, we don't see a recession for the next 12 months. Earnings growth looks really good, 11.2% for this year. You saw like the Fed, it could still cut rates later this year. And here's the key point: there's $24 trillion of cash on the sidelines. Some of this is going to work its way back into the market. So we think there's some good opportunities, especially for long-term investors, to take advantage of this volatility.
You ready? Snake breakout, pullback. Always clean. How many times? Hello?
Hi, this is Marin. The reason for the call is there are some new state-approved $0 premium Medicare benefits in your area that might be available. So do you have Medicare Part A and B?
How many calls do I have to get like this every day?
Okay, let me transfer your call to my senior supervisor.
Are you a
who will
robot
further
AI program? Or I am a robot, I am not programmed to receive. Power hour, 5 more minutes. Put and play. Tessa? Megaphone, baby. We're going. Randy. Randy. Magnificent. Gonna have a grade. Jim, we have a Me Too movement forming here. Damn. It can only handle one me. Now you're talking. You don't get no better than that, does it? That's nice. So, people on YouTube, this is a pullback. So draw in your trend line. Once it breaks out of that snake, once it breaks out of that channel, that's when you need to pay attention. You don't get in that trade until it breaks out of that channel. Once it breaks out of the channel, that's the second step. That's called the breakout. When you're in the breakout, you don't take the trade yet. You still got plenty of time to get in this trade. Wait for the pullback. That's step number 3. Once the pullback happens and you form your patterns, which at first we formed a inverse head and shoulders inside of the snake, which told me we were ready for a reversal. Once we broke out of that snake, we pulled back to that shoulder line for the second time. That's the sweet spot. If it doesn't break out there, it's going to drop. So it has to break out of that second spot if it doesn't do it the first. But when it pulls back the second time, that's I can't express how important the 1, 2, 3 is. And baseball bat, if you ever played baseball, there's a spot on the bat that you can hit the ball as far as you can. If you hit it anywhere else, you could break the bat, you could tip the bat, you could hit a foul ball, but there's a sweet spot. And if you can hit that sweet spot, you'll get a base hit every time. And that's the same thing with this here trend line. Once it hits that second head, that's your sweet spot. If it doesn't break out there, your hopes drop a lot less. If it came back down here for the third time, I'd be shook up, scared. But now we're gaining resistance. Oh, we got a situation. Lunch lady, man. I'd like to know what you were doing. Lunch lady, give me a call. Give me something to remember. Sweet spot. And that's an expansion pattern. That's a megaphone. So once you build support above that resistance line, it's off to the races. And they always pull back and retest that resistance line. Sweet spot. Wow, I ain't got no sound. Oh, it stalled.
Names in the high bar. I got about low bar.
Ooh, that looks good.
In the high bar. AMD's in the high bar. Apple, PayPal,
Damn.
low bar. Yeah. Right? Yeah. Starbucks, low bar.
Where the hell are you eating at?
Etsy, kind of low bar. How about Expedient Bookings?
Yeah.
Expedient Bookings, really high
bar for
sure. Coinbase.
Hey, I think we got a new show for you, Kevin.
High bar, low bar?
High bar, low bar.
Thanks.
Yeah.
Right, Dave?
Around earnings.
We didn't have Harami on. I think that guy's on the Dodgers, right?
The thing that's true is that it really worked out quite well this week. I mean, because there were punishing trades around otherwise good numbers just because the bar was very high. It also makes Alphabet even more impressive.
Yeah, because it wasn't underperforming. I mean, I know we see a pullback, but hey, it wasn't a low bar.
That's where today feels like it really puts a lot back on the table. It's kind of what I'm saying is that bulls feel very much alive again after seeing a fresh stock break out the way Alphabet did.
And the one stock that had bad news, what did they say? Well, we spent too much money on ingredient chips.
Yeah, right.
Yeah.
So, right? This is an incredibly impressive new sector that is evolving right in front of us. But the music's going to stop. There's going to be winners and losers, and they can't grow like this forever. But not now,
Right.
but not yet.
Well, still though to be determined when we're in high momentum modes like we were last month, you want to make higher highs, right? And that's where the Fed next week comes into play. Bonds too, but that's where the relief rally in bonds today, I mean, holding up still pretty good. Kind of a bonus little cherry on top of all of this, but Super Micro's up 8%. I mean, this is the type of stuff that we were just, this time last week, Jenny, talking about how it all broke down. Those Momo trades, the FOMO trades. When I see Super Micro kind of going ballistic again today, it makes you wonder, all right, could we possibly make another run at some of those levels from last month?
Absolutely, because we're now back into our rotation of these like super frothy names. Like also, I can't even believe I'm mentioning this, but look at Snap today. Snap is objectively one of the strongest post-earnings moves on better than feared results. Again, a low bar, but then you look at like DJT, Reddit.
I was just about to say, you knew I wanted a DJT,
I know.
Reddit, both up today.
Both up significantly
DJT
too.
back above $40,
Short selling is getting wrecked.
Yeah, some of this stuff, the highly short stuff, people thought was like toast and done last week. I mean, I don't know. Could we get crazy again, Kev?
The earnings moves that Snap makes on its earnings days
Ridiculous.
are incredible.
That's what I was saying yesterday. The implied move was 20%. It's like walking up to a blackjack table with a $100 chip to play $25 min bet. Like, you're going to have a good time. You're going to last about 5 minutes.
The moves both up and down.
And
they've had some spectacular moves.
You're going to double up or crash.
They've had earnings that crashed the market. There was one in particular where it brought down everything, and it was like, how is Snap doing this? I don't really understand it.
Not risk on. Coming back right before the weekend. Bulls very much live and kicking here today. Thanks.
Yeah, it came down and touched it with a higher low. I'm okay with that.
Tech trade with Super Micro. As we get set up for a conversation, a little preview for those that have
The fact that it didn't touch it
this week's
might be better, you know?
Deep Convo for Market Overtime has one more airing. Don't miss.
The fact that it didn't touch it kind of gives you a little bit more of a bullish take on the trade. I'll be right back. That's not going to be good.
what is middling growth? Is 1.6% middling growth? Yeah, that's middling growth. That's not great, especially at inflation that's close to 4.5% now. It's hard to argue that's not stagflationary at this point.
Fair enough.
And so, yeah, can growth get slower and go down to negative at some point, or close to zero? And
This guy's honest.
Down to 2.5%, 3%. Yeah, that could happen. That's still stagflationary, right? In my book. Now, the response to that will be to stimulate, is what I'm saying. And if they stimulate, guess what? We will get an increase in both of those numbers.
Do you think the Fed would really take that measure with that data in front of them? If inflation
Well, hell yeah, the government doesn't care.
I think if inflation comes back down from annualized 4.5 to annualized 3.5, 3, and growth goes from 1.5, 2 down to 0.5, yeah, they'll stimulate 100%. They've told you they're going to do that, and particularly this year,
Who is this guy?
we start to see
I like this guy.
I think we're about to. It's an election year. What do you think is going to happen, right?
That was your big case last time that you ran us through. That the sample size of populist years all line up pretty much in the same direction.
Yeah, this is and if markets continue to run and inflation is hot, like we were seeing earlier this year, maybe they won't need to. The Fed won't need to stimulate, but you better believe the Treasury is going to. You better believe fiscal measures are going to continue to come out. We just passed another $100 billion in foreign aid. People think that's going overseas. That's not going overseas. That's going to our contractors, which are then going overseas, right? That is spending. That is still fiscal stimulus. Did you see what the Federal Trade Commission came out with? Guess what? Now you can't. Now there's no non-competes, right? What is that going to do to labor costs, right? That is stimulus. That is stimulus to the bottom portion. That is going to increase the velocity of money. All of these things are fiscal in some form or another. They are stimulating demand. It's a demand push economy. A demand push economy is stagflationary.
Right back.
That's stagflationary. If you're not stimulating to supply, which is what we've been doing for 40 years, but instead you're stimulating to demand, the masses, that is going to create a velocity of money that's going to create inflation. Yes, it may do okay for growth as well, but the inflation relative to that growth is going to be much more expensive, and that's the main problem.
So you don't think we're coming down to where they want inflation? You think they would be willing to cut before we get to that supposed level if we slow down enough growth-wise? So far, that has led to one call of yours, which has been the return to 5% in the 10-year. We are getting there. You've been on that. So to bring it back home full circle to the stock trade then, how do we weigh these things against each other when on the surface what you're describing seems like really bad, but then we know what the market does if they ever hear the possibility of cuts? Will that trick eventually not work?
I believe we're in a secular point where we will continue to stimulate in the face of inflation.
Will it be good for stocks?
It will be good for stocks in the short term. I think there's a point in which inflation gets too hot, and then it will be poor for stocks.
Okay.
In the long term, I think it is very poor for equities. 68 to 82, we've talked about this, 14 years, equity markets went nowhere in nominal terms, lost 67% of their value. That is our decade-long view, that we are going nowhere in nominal terms for equities for a decade. That is a big call, right?
Yes.
And essentially, to be clear, we've essentially done that for 2.5 years already. We went down, we went up, we've had inflation all on the way. Guess what? Your money is, your investments are worth less. So,
question for you. I love the big picture macro. We only got 1 minute. You know there's folks that want to know from you what they do over the next week. What do you got for me in the short window? Hit me. We've got 60 seconds.
Yeah, May 1st till May 17th is a bullish window for lots of reasons. I think there's a lot of positive flows coming out of this. The big thing not to forget is that June OPEX for 3 reasons is a very dangerous cycle. That starts right after May 15th, May 17th. Why is it a dangerous cycle? 5 weeks expiration, massive open interest because it's a quarterly OPEX. The quarterly OPEX cycles are the dangerous ones. And there's a Fed meeting, another Fed meeting sitting right in front of it. There's a bunch of event vol built in there. If this decline if this rally that we're going to see or that the support we're seeing does not pick up momentum, if it does not get above technical levels and we do not solve all this deleveraging that need to happen.
Higher highs? We got to get higher highs?
We got to get, not higher highs, but we need to get above, let's say, 1.5 standard deviation on the 20-day and hold it for a day or two on a close. Something along those lines will show the strength that we need to see to keep this thing moving. If we don't see it, we could see significantly lower throughout the June OPEX cycle. I believe this move, no matter what, will be done after June OPEX, but It is a dangerous cycle, and we could see another liquidation to lower lows that we've seen before a rally if we do not gain strength in this 2-week window that's coming post-OPEX.
Boom, there it is, one and only, Mr. Jim Carsad. A week off together, and I enjoyed it even more. Thank you so much, Jen, for your time.
Always a pleasure.
Right, well, like the macro and bringing it home for those in the short-term trading world. Thanks, Jen. Sky Volatility Advisor, Senior Managing Partner, coming out. All right, let's talk some food. I'm feeling hungry after that. Where do you go? McDonald's, Domino's, Chipotle, Cava. You've got an interesting batch of restaurant earnings. It seems like they're in decent shape as we keep swiping our cards.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Accelerate your market knowledge.
And shift your perspective into full view. Real-time example trades and full hours of trading insight.
I'm Tom White.
Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25
Target 1514405 on the SPX.
All at your fingertips.
Anybody want to play my Texas?
Customizable themes, up to 25 shots in just a few clicks.
I hate to look at them. 1,000, 0. And why do I owe
this quarter, but there is competition rising in the fast casual world with stock restaurants.
941, electronic tax payment,
Food Service Manufacturers Association.
Division of
Bill, thanks for
Employment.
being here this afternoon.
Thank you, Oliver. Great to be with you.
Sir.
So tell me about the major themes we should be looking for as investors over the next couple of weeks when we get a lot of these companies reporting earnings. So far, we saw Chipotle still as a beast.
Oh my God. If you want to run a restaurant business, that's the one you want to model after. Ryan Nickel, he's an incredible leader. He knows what he's doing. He's got a track record of success. These guys are like on fire. He's had what, like 20+% increases in in-store sales. His traffic is up double digits. It was the highest quarter, I think, in in-store sales that they had. Digital sales are 37% of what he's doing. His traffic is up 10%, and the peer group is struggling. I mean, there's still some growth, but it's all about pricing, and we can certainly talk about that. Chipotle is the horse out in front, and you better figure out how you're going to learn from there what they're doing.
They also are really working the Chipotle lanes. Do you think it makes sense to even pare down the business process more?
Yeah, so he's all about taking complexity out of the operation. They're heavily invested in automation. They got this machine, I think they call it the Educator. They're smashing up the avocados to make them more efficient in the back of the house. Getting people throughput, is important. Delivery has been very big. The whole, fact that they've been an in-store dining concept for many years. Now they're going to the fast lane and the drive-through. It's going to be something else. Plus, they're adding on stores. They know how to take care of their teams. They're not having the labor issues some of these other guys are having. So I think they've got it really figured out. And they're making it affordable. So the 50-to-1 split that just came calling down, that'll take effect late June. That's a good thing.
Yeah, that'll make it a lot easier to trade for those looking to trade options. Kava seems like one of the brands that people are talking about, names, because they did exactly what you said, which was basically kind of follow the Chipotle model. Do you think that's sufficient enough? What do you think about that business?
Yeah, the Kava guys are right on top of it too. Look, it's authentic ingredients. They're talking to Gen Zs. They're talking to millennials. That's the loyalty base. They're affluent. They understand health and wellness. So Kava's being there. They're getting there. They don't have the girth and they don't have the size of stores. When you think about Chipotle, I think it's got more than 3,300 stores. He's opening 300 a year. Kava's about 300-400, and they're opening like 30. But Kava's another one to watch. They're very well run. They're committed to the authenticity of the ingredients, just like Chipotle, and I think they're doing a little bit of innovation as well. But clearly, they don't have the dollars to spend as fast as Chipotle has in reinventing their business. The loyalty programs are insane with both these concepts. These guys over at Chipotle have 40 million people in their rewards program, and they're active, loyal users. You know what that means?
Recurring revenue.
Yeah, and take the prices up. Get ahead of everybody. You take your pricing. These guys have taken, Chipotle took 6 price increases before the last one with the California minimum wage going up. So they've been able to stay ahead. Their margins are really good. Kava's in the same kind of situation. They're watching what they're doing, and they're very good with their margins. But again, they've got a long way to go just because of the size and scope of their business.
Do you want to see any fresh implementation of AI, of technology, or have restaurants kind of maxed out what they can do? I'm kind of thinking like McDonald's and Domino's in that conversation that have been tech leaders in the past. Is there any further juice to be squeezed from tech in your mind, Phil? Is there growth to be found from that source?
Oh, totally. They're just getting to it. The big boys are getting into it. They've already been in it. When you think about, and particularly Domino's in the pizza category, that business is always a promotion business, but they've been able to automate themselves. They're more of a technology company, tremendous infrastructure and investment in their consumer information and what they're doing with respect to their supply chain, demand planning, anticipating orders, and some of the operational things they're doing. Chipotle has heavily invested in AI. He's not talking as much about it as he should, but internally they've got supply chain models that help them with demand planning so they can pivot quickly when they have issues. Everybody was giving them a hard time the last couple of days about some chicken shortages. They blew through that without any problem, and behind the scenes it's because they've got the technology to do it. The same thing happens not only in supply chain, but this automation in the fast lane. They can anticipate what you're going to order when you know who you are, because they're taking the information that they see off your license plate.
Scary stuff, so but get me my pizza fast, exactly the way I want it. A little crispy, a little extra cooked. Appreciate it, Phil. Great conversation. Thank you very much for your time.
Thank you, Will. Thank you very much.
Yeah, good reminder of why one of those stocks this week did so well, and it is Chipotle. All right, we do have plenty more earnings on that front. We'll pick up next week for consumer stocks. Thanks to Phil there for the look at where the trends are going. We got 2 bullish trades, including one that hits near to one of my favorite subjects right now, the rally in copper. We got a bullish trade in Freeport McMoRan coming up.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Snap is pacing for its best day in over 2 years after reporting first quarter numbers that beat across the board. The social media company posted surprise earnings of 3 cents per share versus the 5 cent per share loss the street had been expecting. Revenue climbed 21% year over year, and daily active users climbed over 10% to over 422 million. Over the past year, to re-find its footing in the highly competitive digital ad space, Snap has attempted to reach out to smaller businesses as well as individual content creators. And this seems to be working because on their earnings call, management said that small and medium advertisers on their platform rose 85% from a year ago. And rounding out the strong report was its better than expected second quarter revenue guidance, as well as better daily active user growth than the street had been expecting. For more on Snap's earnings, check out the Schwab Network app or visit schwabnetwork.com.
Copper has been moving. It's the big commodity winner here the last 2 weeks. Freeport McMoran's got some bulls trading their stock. Mr. Rick Ducat, welcome to the Options Corner on Friday, sir.
No bull here, Oliver.
Nice. But there are bullish trades.
Exactly.
Okay. All right, load us up. What do we got for Freeport?
Well, this one, I highlighted this one because it was one of the few interesting spread trades that I found today. And, you know, earnings were Tuesday morning. Almost a 2% downward move here. Nothing too crazy, but not great. But we've had a nice recovery since that point here. Argus Research yesterday raised price target to 54 from 44, maintained their buy rating. A lot of analyst activity today. Raymond James, Deutsche Bank also raised their price target. However, Bernstein, Scotiabank, JP Morgan all lowered their price targets. So kind of a mixed bag for everything going on here.
What's so confusing about it? Copper's going crazy. What's not to love? The gold's been going crazy. Freeport mines them both. You know, like,
that's my take.
What are they debating about?
Yeah, exactly. I'm not going to dive into all the notes here.
Yeah, that's fine. That's fine.
Yeah, but nice recovery after earnings, and at least one trader is expecting it to continue its upward path here and make some new 52-week highs here. So here's the trade: plus 3,672, May 17th. 51.56 call vertical spread at a $1.06 debit. So a long call vertical, 21 days out, you know, needs about a 3% move to the upside to get to the point of the break even here. And if we were to pull up our chart here, we could see that the point that on the chart where we would have our white dashed line there, that's the break even for the trade, basically expecting it to make its way above those 52-week highs. Now, I also have standard deviation channels on this chart. The 56 strike, that short strike, which would cap our profit, roughly at the +3 standard deviation channel there. So they're expecting a pretty extreme move relative to our own price history in a fairly short amount of time here. So that would be an interesting situation to be sure here. And the trade is almost a 1-to-4 risk-reward ratio. Expected move is about $3.51. So the break-even is within that range. This would not be, you know, some kind of outsized move we would need to get to that point here. $1.4 million max profit, $389,000 total risk is the cost of the trade to put it on here. And in terms of the options market today, about 114,000 options traded, 78% were calls. The sizzle, 1.6%, meaning, or excuse me, 1.6 meaning 1.6 times the 5-day moving average.
All right, so it's pretty juicy. It does at least seem like the stock is reflecting some of the action in the underlying commodity from that perspective, given that the options market is a little bit hot.
A little, yeah.
In there right now. And ultimately, someone is looking for upside here. So, look, I mean, copper has been a massive sleeper winner of a trade. We're at 460 in copper after breaking through $4. I mean, it's been relentless now for several weeks. So I'm glad you found this trade. Fits in with the China trade as well, which had a very good week again. Chinese stocks were moving, so that's my way to kind of add in that piece of information that I think was an important story this week. We got trades in IBM and Apple. IBM post earnings, what do we see?
Well, the IBM trade here, earnings Wednesday afternoon had an 8.2% move to the downside, so pretty rough earnings activity there. Morgan Stanley today lowered their price target to 179 from 186 here, and they maintained their equal weight rating here. So at least one trader once again thinks that the pain is not over yet. It's a pretty bearish trade here. Plus 9,154, June 21st, 155 strike puts at a 150 debit here. So basically looking for an 8.6% move to the downside to break even. The break even will be 153.50 here. Putting on a trade that's worth about $1.3 million to put it on. That's the total risk as well here. And this is this is a trade where if we could look at the chart here, we can see that white dashed line once again is the break even here. And I decided to include standard deviation channels again to show that we're giving up a key point. We're falling below that -1 standard deviation channel that is supportive. So it's kind of opening the door to further downside here. So this
chart had been looking okay. This is a real bad break.
Yeah, it had been looking pretty good. We closed below that gap that we established previously during our last earnings event. We're kind of moving lower here. But this trade is looking for actually an even bigger than expected move here. The expected move is $11.27. So that would be more like 6% to the downside. The break even is significantly beyond that. We would need more than an 8% move to the downside. So banking on a bigger than expected move here. Like I said, max loss would be $1.3 million. That's the amount they paid here. Max profit, $140 million if it goes to zero. In terms of the total market today, 67,000 options traded. Roughly 60% were calls. Sizzle, 1.3, so slightly above average activity.
Okay. All right. So if we look at the actual breakdown of the stock, it's a rough week for them. It's not encouraging, but hope, I guess, that maybe that would hold, but this trader doesn't think so. So it's a pretty negative view there for our IBM, frankly. Last one, next week, Apple, bullish trade. How bullish are we talking?
Pretty bullish, not terribly bullish here, but I thought this trade was pretty risky here because the Apple earnings event is on Thursday afternoon, so that means the options that they're trading expire that Friday. So basically it's an all or nothing trade. If they miss earnings, if they go below the strike price, those options could go up in smoke here. So to talk about the trade here, plus 2,776, May 3rd, 170 strike calls at a 415 debit. So long calls, bullish, unlimited max profit potential here. We got a week till they expire, but it takes in the earnings, like I said here. So the expiration break-even price would be 174.15. Our strike price plus our debit paid, 2.6% to the upside roughly right now. So you can see once again, white dashed line there would be our break-even point, and they're looking for a move like that would be beyond that point. So if we were to perhaps break above and get back to that double top area there with our red dashed line there,
that'd be a big deal.
Yeah, that would be about $1 million or so profit for this one. So that would be about 178. That would be an area where you might expect to find some resistance there. So that could be, just a possible scenario that I was exploring when I was looking at this trade here. Okay. Now, the thing is, if the earnings miss and if price is anywhere below 170 after earnings, these things are probably toast. Like they're going to be $1.1 million up in smoke there because they have so little time to recover before the options expire there. So expected move $7.29. The break even pretty comfortably within that expected range. So it's not like this is some crazy moonshot trade that needs a big move here. It needs a rather modest move in order to be profitable, but it is carrying some risk here. About $1.1 million is the total risk, and it's, like I said, kind of an all or nothing here. One of the most actively traded names in the market, 526,000 options traded, calls out.
You got puts for Monday?
Sizzle, once again, 1.3, slightly above average.
Yeah, some people are looking for bounce back in Apple. Seems like generally pretty bullish options flow, but that would add up with what we're seeing in the stock market and with tech this week. So good preview for us. Thanks for good cat. All right, get us ready for next week. Coming up, let's talk some commodity moves.
Always clean.
Currencies. We're dealing with a strong dollar. Some would attribute that to a more patient Bank of Japan, apparently than expectations. We'll also talk about how the government's getting involved in AI, a headline that you might have missed today about a group being formed.
Okay. Yes, ma'am. Bye-bye.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
So
Ethan!
I've been in business for 20 years. Well, I've been in business longer than that, but this business that I have now, I've been in business for 20 years. So I get a letter from the unemployment agency, Labor of Industrial Relations. I was late, I guess, on a bill back in 23, which I don't think I was. I'm always late. I never pay them on time. So they sent me a penalty of $100. And I called them up and I said, I ain't taking this. And being as I've been in 20 years, I've been in business, this is my first penalty letter. That's what I'm just so fed up with this anymore. Being a business owner, I mean, if you're small, it's not as easy as it used to be. Used to be a piece of cake. I'm an accountant, also a marketer. So I got to write that email. They're going to, maybe I can get away with not paying it, but just pay the bill and get it over with. I had an art gallery for 5 years. Go get some more water.
We're going to be cutting relatively soon, particularly the east.
Oh, look at that knife.
But yeah,
Megaphone.
Today's price action, even though, I mean, yeah.
Oh man, I got to show this. Come on, give it. Megaphone SPX. Megaphone. Megaphone.
shares today, but what I can tell you is that out of the 4 that I talked about, Microsoft, Amazon, IBM, NVIDIA, they were all higher today except for IBM. No clue if this has anything to do with it, but just
bad earnings. All right. Thanks, Renee. Appreciate it.
Of course.
All right. Good stuff. When we come back, our big picture discussion with Schwab team. 2 smart guys taking you into the bell. It should be fun as we wrap up this week. Equities looking good.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, anytime, anywhere, on any device, for free. Schwab Network.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financial?
You were shook up that day, honey. I remember holding your hands. I had to put a cup under them. They were so sweaty. Nailed it to the 9. If you can count to 4, you can make more. Number 9.
Areas like communication services today, last I checked, you're at about a 4% and change gain for that sector after a 4% drop yesterday. So I think a lot of it is a little bit of a bounce from maybe some things that had seemed, oversold. Parts of the financials got that way, a little bit earlier in the week, or parts of communication services looked like that yesterday. I think what's more interesting is to look at the leadership profiles since the market's most recent peak in late March. And the 2 top performers right now are energy and utilities. So it's not really sending the clearest message in terms of cyclicality or defense, because you have, a deep cyclical sector, but you also have a deep traditional defensive sector being utilities that are leading. So I think right now it's more about looking at longer term trends, what might be driving those. For energy, I would argue probably a firmer increase in oil prices over the past few months. For utilities, probably still working off, a deeply oversold level that you got to in October of last year.
Okay, so you're saying kind of mixed messages a little bit if we kind of go from sectors as defined or themes, defensive versus kind of more cyclical and aggressive. What about the interest rate sensitive groups, like the Russell representation of the lower quality names? Did the possibility of a wider broadening out of that group get killed by the bond market, Kevin?
It's tough for the Russell, because if you look at some sectors, there are some in the Russell that have actually done quite well. So energy industrials, to some extent, even parts of financials, not necessarily the banks. But if you look at other areas like telecommunications, that is at hovering near a 3 or 4 year low, depending on if you're looking at it in absolute terms or relative to the Russell 2000 itself. So I think you have to kind of, peel the onion back a little bit when you're looking at the indexes right now, especially in a post-pandemic environment, because, the index could be telling you one thing, which for the Russell 2000, it keeps bumping up against a ceiling and hasn't really done much over the past few years, is really struggling to, firmly get into a bull market. But if you looked at some of the underlying breadth within some of the sectors, there is some strength there. And also sector composition itself. The Russell 2000 is weighed heavily by healthcare and consumer discretionary. So those two sectors, one of them being hit hard by biotech, the other being hit hard by just a weakening consumer at the lower end, I think that makes it harder for the index itself to rally.
All right. Okay, like that. Let's talk some bonds. Bonds. I love them, Cooper, and we're holding 4.65 in the 10 years. So was there continued conviction in the bond bear trade this week, or what do you make of some of the pushback that we got today?
Yeah, so I think the move on today, we're not seeing too much of a big move today. 10 years down, just a few basis points. 2-year continues to hover right around that 5% level. So I think that that's probably a technical level. Tends to be that those round numbers are psychological levels, Oliver. So I wouldn't be surprised, given if we don't see any major moves in the data, that we might hover around there a little bit. So what I think, though, what we looked at for today's data, we obviously got some inflation data. Wasn't as bad as expected, so I think that caused really the market to really breathe a sigh of relief. We also got the spending and the income data, and I think that was better than expected. So that bodes well for future results and future releases. So I think that's part of the reason why the Treasury market really hasn't sold off too much, hasn't moved too much on the day so far.
And we got a little bit of stickiness in inflation expectations from the sentiment number. I mean, all of the inflation stuff this week continued to look on the warmer side. How does that set us up going forward, Cooper, as we will hear from the Fed after this blackout period ends pretty soon?
Yeah, so I think then what it's going to reinforce is the message that we really have heard from the Fed already, and that's one of patience. So inflation, like you had mentioned, it isn't coming down as quickly as expected. We can slice and dice it on a 3-month, 6-month, 12-month annualized basis, however we want to do it. But the point is, it's not trending towards that 2% level that the Fed wants it to see as quickly as probably they want it to get to. Even though we are in a blackout period, what I would not be surprised is once we come out of this and we have the Fed meeting next week, they're probably going to reiterate their theme of patience. It wouldn't be too surprising if Chair Powell downplays the March dots plot, which projected 3 interest rate cuts. I think 3 interest rate cuts at this point seems a little aggressive, so I'd be expecting more. They tone it back down to maybe 1 or 2. Now, this isn't a meeting that's going to be accompanied by the SEP or the dots plot, so I'd expect most of the information that we're going to get is from the press conference, and then maybe set the stage for what we should expect later on down the road. But again, I think what we should expect later on down the road is more patience.
All right, so they can polish a little bit the message. Now they have a week to process and a week off from the public realm. Thank you guys for joining me. Great stuff. Kevin Gordon and Cooper Howard with the stock and bond big picture analysis from the week. Coming back, little breaking news in the sports streaming world. We'll catch you up on with Amazon, and we'll get our closers panel in here and do a little preview into next week too.
One more minute.
Young lady who was mid-30s, a couple of kids, recently went through a divorce.
Johnny!
She had a lot of questions when she came in. I watched my mother go through being a single mom.
You don't have to tell the world.
My mom.
Snitch. Okay. I'm going to go over the week. I'm going to go ahead and talk a little bit here in a second. I want to talk about this last trade. Anybody in here still? So, this is a pretty easy trade. It's a pretty easy concept on how to trade the snake. All you got to do is learn how to count to 3. We've got a snake. They come down in stair steps. And we got a 1, 2, 3. And we broke out. When we broke out of this, we created a head and shoulders. I extend this trend line to the left. This is a shoulder line right here. Shoulder line, and then second hit. Boom! And it continued up to the upside. Created a trend line. Also, right out of the snake, you created a downtrend. 1, 2. So there's your megaphone. Start right there. So you know, maybe later in the day, it could pull back and hit the bottom part of that megaphone. Run it on up. If you can count to 3, you can trade with me. So we get up here to the top. It's so easy. Get up to the top. God. So you got 1, 2, 3 tops, and she knifes. 3. 3's a charm. You ever heard of that statement? And ever since I started trading like this, I don't breathe as heavy. It gives me all the time in the world to take the trade, to get ready to get out, as long as I know how to count to 3. So I'm sitting here, and we came back down. So we got the right shoulder there, left shoulder here, and left shoulder here. So we came back down and hit that shoulder line, and I scalped that trade for 60 cents. That's the bottom of that megaphone. It broke out. It came back and hit that thing again. It was too late in the day to even think about taking the trade. But I've seen more megaphones lately. You know, I went through a period where I saw triple bottoms. I went through a period where I saw ascending triangles. I went through a period where I saw inverse head and shoulders, which we have right here. Now we're going through a period of megaphone. So I got to come up with some kind of, is it because we're at a top and we have more volatility? Is it because Wall Street had it wrong to begin with? I mean, they've got to eat their words. Jay Powell, for example, he comes out and he says, we're getting close. A couple months ago, we're getting close. We're going to cut the rates. We're getting real close. And then the numbers come out and they're all not what he wants to hear. So we're not getting close. That's why I think it's important to fire these idiots and get them out of there as long as they're too involved in politics. Because all they're trying to do is bail out Biden. As far as I care, we get rid of them. Or we simplify it, make it easier. You know, give a board of 10 and that's it. I don't know what kind of money, what kind of budget they have. But I bet you it's real expensive to keep them guys in business. And we can save a lot of money. And go straight to a purchase plan. Whatever you buy, you pay tax on, and that's it. Now to keep the government from spending and ripping us off. So that's the biggest problem, I think, is inflation. If they don't stop spending, you can't fix inflation, period. No matter how hard they try to screw you on the outside. I mean, my credit cards are up 15, 16%. I'm going, fuck, I've never missed a payment. You know? And I call them up, I tell them, hey, I've got a Class A credit. Why in the hell is my interest rates going up? I told them I ain't using your cards no more. Screw it. I got one that said 19. I'm going, what? So, a lot of megaphone patterns. Have patience, snake, break out, let it form that pattern, and then take the trade. I mean, this was a beautiful 1, 2, 3, boom. 1, 2, 3, boom. 1, 2, 3, boom. Head and shoulders and a megaphone. So that's it. I want everybody to have a great weekend. Love your mother and your brother and your sister and your father if he's around. I'm going to do some videos this weekend. I want to do a video on this. I think this alone could help you. This alone, okay? Let's look at CRM. If you just built this one strategy, so pre-market, after hours, you have a support level right in here. These two dots. I don't know what the heck's going on here, but I'm going to use that. So that's inside of the pre-market and after hours. You go up to the top up here, and you hit the resistance line of a double top. That's your channel for the whole day. That's your channel. So you get in it at the right at open, and you run it all the way up to the top. You got an inverse head and shoulders, and get out of that trade. Boeing. Okay. So here's this. Well, that's almost straight at open. I think that's at open. There's a support channel. And there's the resistance channel. So I get in here. I got a head and shoulders. I take the right shoulder and I run it up to resistance and I get out of the trade. That's $2. It's $1 something scalp right there. You're playing that in the channel pre-market and after hours. That's all you're worried about. That's all you're going to do. That's all you're going to trade. And you're done. You're out of the, you're out. C. Same thing. Draw your trend line. Here's your bottom right here on that red dot. Run it up to the top. Take that trade when it pulls back to that bottom. Run it up there and get out of the trade. Or take it to the previous high. So you took 61 to 62, 50 cents. And it depends on what kind of run you're having. I mean, something like this, in a little pullback, you might want to continue that run as long as it holds the 9. Tesla. Okay, we got pre-market right here. So we put the price line in there. And we got the high right here. So we jump in the trade on the 1, 2, 3. And we run it on up until we want to get out of it. Playing inside of this channel. And Tesla's Tesla. Visa. So here's Visa. We just had a good knife right at open here. Breakout, pull back, boom. Yesterday's highs. You're out of that trade. That one's not a very good illustration, but that's still good enough. I'm just picking some out of the sky. I don't know what I'm looking at. QQQ. So I'm coming in here. I'm going to trade the QQQ. I got my resistance level right there, and I got my support level right here. So I come in, the bell rings, we pull back a little bit, we regain consciousness, and we take the trade and run it up to that pre-market resistance and get out. Go to the beach. Have a winning trade every time. Almost. BAC. So we got BAC here. So we got pre-market low, pre-market high. It pulls back, almost pulls back to a double bottom here, but we got a little inverse head and shoulders. There's your head, left shoulder, and your right shoulder. Right when the bell rings, we take it off the 200 and we get out at the double top. That's not big of a spread there, though. Some of them look a little bit better. Let me think of one here. NVIDIA. A good one. Ones that I noticed on my watch list. Ooh, this automatically broke out and just kept going, didn't it? So that's not a good example. Not a good example. Not much on that one either. I mean, you got to have some meat in here. But I know somebody that trades like that. He's worth $100 million. And he only had 1,000 when he started with. Just that pre-market after hours channel. I didn't look at MU today. Or Disney. See, here's a good example. MU. If I saw this MU, I would probably took this trade. So we got support right here. Snake, breakout, pullback, boom. 112 to 114. $2 scalp, and you're out of the trade and you're gone. SPX. We broke out this morning. I didn't even think about trading puts because I come in here this morning and I looked at the chart. And I should have thought about that yesterday when I got in that. What's I going to do with this? Can't remember what I was going to do with this now. Yeah, I'm going to call it a day. I got to see if I can get out of this $100.34 fine. Interest is 34 cents and the penalty was $100. Can you imagine that? And I paid that sucker. I wrote a check for 33 cents. I remember doing it. Huh. Okay, well, I'm going to get out of here. I hope everybody has a great weekend. Yabba dabba doo, Florence. Rondi, magnificent. You're such a great man. I'm so happy to know you. And I'm going to get on out of here. I'm just a wild guy sometimes. I left my other room because I wasn't having fun. If I can't have fun, I don't want to do it. So I'll catch y'all later. Hello, Argina. Parge, I'll catch you later. Mo, have a happy Friday and a nice weekend. Did you like that, Percy? Neckline resistance of a Head and Shoulders? Not too many people know that. I've only heard a couple talk about it. Gold star work instead. I can't figure out what that means. Well, I'll catch you all later. Hit the like button. Pay attention to the video that comes out this weekend, YouTubers.